Ladies and gentlemen, we should be live. So, for the
Awesome.
first time on the channel, okay, we've had Roy on a ton. He's definitely the main guest, but
Oh yeah.
we squeezed in Jesse here. Really do appreciate it, Jesse. Holy crap.
Oh,
This is the first time actually talking to you one-on-one. How you doing?
good, man. Sorry about that audio interruption. I'm excited to be here. This is great.
Yeah, so if I'm correct, PayPal earnings should actually be coming out at 4:15. I'm going to be refreshing like a madman.
Cool.
I got their web call or their webcast up, so we're going to be listening to that as well. There should be a couple guests funneling in and out of here as well. So we got Stephen Fiorillo that might be popping in. We have a couch investor that's going to be popping in. You know, depending on how well this stock does or burns out, who knows? Maybe I'll go longer than a minute. Maybe I'll do like a 9-hour live stream.
There you go. If I make a bunch of money, I'm probably going to have energy, so I'll hang out.
Yeah.
If I don't, I'm probably bailing really quick.
Well, and we'll talk about the fundamentals mostly, but it is fun to we're all in it, to make money, and so we hope that it goes up. But man, if they execute on the fundamentals, I think the price will eventually follow. And so we've seen some good things so far, and this is the roadmap quarter. We have to see them execute beyond this, but there will be a good roadmap today.
Yeah, and my expectations are super low. I mean, it's a low bar, so hopefully they can beat it.
That's what I was going to ask. And why don't we take a look at the after hours stuff like this? I'm kind of going to leave it to you, Jesse, because there's no one better that can follow a stock on a day-to-day basis than you. I follow you for most of what you have to say online, and so does the rest of the other 50,000 people on X, or coming up on 50,000. If you guys aren't following Jesse, I have a link down in the description down below for everyone's Twitter, X accounts, whatever. So make sure you guys are following them. But let me share your screen really quick.
Sure. Yeah.
So this with Jesse, I was going to say where I'm very weak is macro and TA. He is an expert, so he's a must follow. Just add him.
Sweet. Yeah, I don't know about an expert, but I've gotten really good from making a lot of mistakes over the years. So I definitely, I've got some skill in it. But yeah, I'm excited about PayPal. I think if you look at the chart here, I was talking about this on a Mitt's channel earlier. It's just like this massive cliff that we fell off 2.5 years ago. And for over almost 2 years, we've just been trending sideways. From a technical level, this thing screams that it wants to go higher. So I'm looking forward to at least a move to like the mid 70s or 75 range towards this 100 moving average, the yellow line that you're seeing on the screen. Potentially today, if they just don't suck at earnings and they paint any kind of real vision on the future. And I know a lot of people have trashed on kind of like the merchant video that was done and the timing of will shock the world based upon people's perception of when that was going to be. I never thought that was going to be on that video. And I actually was pleasantly surprised by it personally myself, but we could have a mean reversion on this. All that means is that 2 years that we've been grinding sideways, we could close that gap really quick. And if people don't believe that, if you look at like Meta, Tesla, Palantir, and the money I was able to make making smaller moves than this, it's very possible. This company has had really horrible narratives for a long time. They had the Canadian trucker thing, and then we might suppress free speech thing. And those were, no matter what part of the political spectrum you're on, it wasn't great press. And so I think that this stock has been really beat up. Also too, it went up a ton over a short period of time, but it's beat up and it's at levels it was at 6.5 years ago. So this is the kind of thing you want to see. There's something called the market cycle. This is like a perfect image of a market cycle where you're getting ready to start back up again. And so I love this chart. I'm super excited about it. And hopefully we make some money today.
Can you talk on your position for what you have with PayPal, or what percentage of your portfolio it is?
I probably have too much. It's about 15% of my portfolio. I think it's like 400 grand. About 370 of that is calls that are dated January 2025 for like 140 strike, I think, which is right underneath this 200 moving average. That's why I picked it. I also picked it because it has high volume. So if that happens, I don't even want to talk about how much money I'd make. But if it just gets to the 100-ish range, right here between 100 and 104. If it did that by mid-April, I would make anywhere from $1.7 to $2 million or $2.2 million off of that 370,000 that I have in there right now.
Just a measly 2.2 million.
Yeah,
That's
so I'm hoping
perfectly
it
fine.
happens. I'm hoping
Yeah,
it happens. I'm not gonna lie. I want to get my Cybertruck right away. I've been looking at wraps, and I that 2.2 would be a sweet figure to make that happen pretty easily.
Yeah.
To
So,
justify it to the wife, that's for sure.
Roy, just really quickly, I want to ask you a question on what you're actually looking for in this Q4. So, one of the things for people who are new to PayPal or potentially haven't been watching it as closely as some people on the panel, we have a new CEO now, okay, Alex Chris, and he's promised us from last quarter that this earnings results will be quite different from an investor side because they're going to be showing all sorts of different new metrics to help value this company or key performance indicators that they're going to keep up with to help properly value it. What are you expecting from this company that you want to see that'll help value the company, Roy?
So since you said really quick, a roadmap.
Sure.
Totally.
Yeah.
To elaborate on that, so when he came in, last quarter was a diagnosis, and so he came in. He had to figure out what's up with PayPal. Like, why are we at this position? Not just as a stock, but as a company. And there are some issues, legitimately, why it fell off a cliff. I think it's way overblown. Fundamentals are still quite strong in many areas, but there's some areas that needed to be addressed. He was very quick to diagnose those. Fantastic earnings call last quarter. This quarter, I've always thought as a roadmap, and he's reiterated that several times, both in the previous earnings call and alluding to a couple of things as well. And so what we're going to see is a focus on 5 new KPIs, key performance indicators that he's going to roll out and say, okay, these are the things that we are looking for and looking to increase. Hold us to this as we go forward as a company. They're going to be not qualitative, but quantitative. And all of them are focused on profitability, on improving margins, on actually making money instead of something else that really doesn't matter. Because bottom line is, PayPal is here to make money. Like, if they have green energy and whatever, great, do that. But make money, guys. And that was kind of lost under Schulman. So
Totally.
Chris is just a different guy. He's coming from Intuit. They have crystal clear earnings, the way that they break it down. And so I think we're going to see that. We're going to see it. Even the slides, I think, look differently. And there's going to be a lot more transparency. So we'll be able to see, I think, a better breakdown between those 3 segments that were rolled out after, it was like almost 2.5 months ago now. And so we'll get to see a further breakdown of that, where they're growing, where they're not. And I think more than that, he introduced the first look products as the kickoff of needing to extrapolate and actually expand on that, but to shock the world with the results. And so I think that we're going to get an idea of the roadmap of when will these things, within 2024, all of them will come, but when will these things be implemented and how, what to expect. We'll get to see, of course, what they expect as far as earnings through the year. Some analysts say, oh, we might just get a quarter or two. He's going to give us the whole year. That would be pretty unusual if he doesn't. There would need to be a very valid reason for that. It's rare, and it's normally bearish when they don't. We'll get to see that roadmap with crystal clarity. Beyond this, it's all got to be about execution. So I agree with Jesse. Expectations are pretty low on this. I'm probably a little more excited than Jesse, and Tanner is thinking margin inversion might actually happen, maybe, possibly. I think he's wrong, but hey, if it does, great. But we also need to see, okay, when will margins actually invert? What kind of EPS efficiency gains are we actually looking at? What do we think that Brandon's going to do? And I think that they'll lay that out crystal clear. Some clarification will come, of course, when the analysts come and they ask the Q&A period.
So what do I just add to that? So we got probably about 5 more minutes before the actual quarter is released. Okay. I'm looking right now. I don't see it. What I heard is that it's 4:15. So we're good. Then I got the call scheduled for later on. We're good. The things I need to see, they've only shown this off a couple times. It seems for a payments company that this would be the most important metric. TPV, or total payment volume mix. Okay. What that is how much is actually coming from branded checkout, how much is coming from Braintree, how much is coming from Venmo. Seeing how that's evolved over time is so important, and they don't always show it off. Stock-based compensation has also been kind of out of whack. I think it might be for the next 2 quarters. We've taken on quite the amount of high level executives. I don't know for the people that are paying close enough attention. They've practically reworked all of their top executives. They're all new. Buybacks. We want to know what buybacks are. We want to know conversations about dividends if possible. I know Steven's been on that. I don't think we're going to see it. Alex Chris has been very clear that this is a growth stock, not a value stock. And so I don't think that there will be too much of that. But yeah, there was, and then Jesse, I'm going to bring up your screen here in a second, but there was also a lot of talk about some of their new innovations and margins that they're bringing out. Buy now, pay later. I want to see full transparency about this product. It's an unbelievable product. I think it can take PayPal to the next level. And then Braintree. Braintree is their white label full stack processor for payments for large companies. You're talking Uber, Meta, Google, Airbnb, Ticketmaster, Spotify, TikTok. All of these massive companies use Braintree. Why that's so amazing is that although Braintree actually might even be a loss leader for the company, the types of payment providers that they'll offer, they'll give preferable placements to companies or to processors like Venmo and PayPal. That's why it's so great. I want to know how they're growing. Alex Chris said they're going to charge more for that. How much more? Let's actually see some numbers. So
yeah, that Venmo Amazon thing, I want to hear about that. I hope an analyst talks about that because I don't know that they'll bring that up in the call directly, but
exactly,
that's helpful.
Exactly. So let me share your screen, Jesse, and I'll get your thoughts here.
Sure. Oh, and I have this on the take rate. I wanted to show this here too. Again, like all the stuff you're talking about, I think they need to. I think they need to focus on profitability. I like the 9% staff reduction. I would like to maybe even see more reduced. I would like to see single platform. I know I've heard that. I heard that from Alex on the interview that he did with CNBC, where he's talking about shocking the world. In part of that interview, they didn't put it on the short one on CNBC's site, but they talked about a single platform and some consolidation between the Venmo and PayPal. And if you've used PayPal as a mobile app, I don't even know if they have it in Canada, but it sucks. It sucks. It's like there's so many different options. It's confusing, especially for old people like myself. And so I would like to see it where, again, like they talked about the biometrics, where you put your thumb or your face, it just comes up and then you just click pay. And there could be other options there too, but I don't want to see 7 options for transferring money. I want to see pay and just have it work. And so I just think that there's so many things that this company can do. I actually am happy that it sucks so bad, because I think Alex's ability to look at these things and fix it is going to be transformational. And so I'm actually happy that the bar is so low on what he has to do. And I look forward to seeing any improvement at all. But you're right. I just want to see some improvement. I want to see more of the vision, and I would love the KPIs to be robust and showing us consistently from quarter to quarter the same metrics, and not just like the ones they want to show off because they look good.
Right. There's a large investor named Brad Gerstner from Altimeter Capital.
Yeah, he's awesome.
They just took a stake. They said it's a small stake, but they just took a stake in PayPal. Very famously, they put out a letter for Meta talking about how that company needs to do a turnaround on this company, reduce some of their metaverse action, and just focus on. I forget what he said. A flatter company is faster, and a simpler company is better. I think that was the famous quote.
And with Meta too, you're right. I think with Meta back then, if I remember too, he was one of the reasons I was excited to invest in that and why I made so much money. But he said that he didn't want to be an activist investor with Meta either, which is the same thing he said with PayPal. But that he wants to help, guide in whatever way he can for them to be more efficient and to be simpler. And I think that's great. I think Alex could use that help. Brad's awesome.
So we should be seeing earnings results come through now. I'm going to get searching. I don't see anything yet, but it is on the 4:15. I'm going to keep an eye out.
Yeah, one thing I'm not expecting to hear much about is
out.
USD. Something's
running right now.
That ticker's moving, guys. Holy shit. Excuse my French. I'm gonna have to turn off
That's
some
okay,
alerts. That's
Jesse.
gonna
By
get
the way,
crazy.
Today.
I was wearing a red shirt today, and I changed it to green like an hour ago. So
There you go, up
Perfect.
6%.
So this is Roy. Oh my God, we're going.
let's
Sweet.
go.
Give me
We'll see
70,
what the results
baby.
are, but man,
Are we in
that's
front of
a
a
good sign.
video lottery machine? That's what it's feeling like. I'm gonna have to bring this up higher. Did I just
Okay, I got
make,
it.
like,
I got first results here.
All right.
oh my God, I gotta see how much money I'm making.
Revenue increased 9% to $8 billion. That's a beat.
Sweet. Good beat.
GAAP EPS of $1.29. I think expectations were 127. Let me double check here. Where is it? Come on.
Now we just have to see if PayPal gets slammed all of a sudden by something we're not seeing yet. That's the fun part.
Yeah.
No, from what I'm seeing, that actually might have been a miss on EPS.
Oh no. Okay.
But
other people are probably
not
reading that.
non-GAAP. Non-GAAP grew to $1.08 or $1.48. I need to punch this all into my spreadsheets to see the quarter over quarter action here.
We're red.
Let me see guidance here. Let me share my screen as well. Okay, guidance expecting approximately 6.5 to 7% on net revenues. GAAP earnings, mid-single digits.
Let me pull up mine too.
Total payment volume did a 15% year-over-year growth. GAAP 8 billion. Yeah, they've never missed that in the last 2-something years. Operating income much higher quarter over quarter and year over year, clearly. This is usually why I like to give myself 30 minutes before going live, because I just want to punch all these numbers into my spreadsheet so I can actually compare them.
I get that.
Okay, let me see. This is what you guys are calling a brand new thing with new KPIs. You're not showing anything here.
Maybe there's another one coming that we're not seeing yet.
Yeah, there might be. Sometimes companies will do that.
Or it's next quarter. All right, so we were up 10. Now we're down 5. Now we're down 4. So we're just kind of meandering.
I bet. That's such a crazy move on the stock in that small amount of time. Up 10.
Yep, 10%. But it's so low. It doesn't take much.
Sure. Yeah, net income up 18% year over year. Okay, I got their investor update now. Here, I'm going to switch over.
Cool.
Perfect.
Okay, CEO observations, strong franchise, accelerated our brand checkout business. Yeah, see, this is hopefully what they mean by more focused business is just driving PayPal. You don't have to worry about all these additional businesses. Like PayPal as their own branded checkout is a machine in itself. Okay. Focused on profitable growth. Okay, transaction margin year over year. Oh, I think we actually did see an increase in transaction margins.
Yeah, 0%. That's good.
Well, 0. So quarter over quarter, I was right then. 0 or quarter over quarter, they did see an inflection.
That's actually really good.
Yeah, I'm surprised they're down on that. It must be the guidance, because the guidance looks weak on their revenue. Active accounts, I think, went down quarter over quarter. They're now showing monthly active accounts.
Price is recovering. I think the market's starting to catch up here too.
Look at this TPV mix, baby.
Yeah.
That's what we needed to see.
Oh, that's beautiful. Like we've had to guess and then like pick numbers from here and there, and
yeah,
it's just so much better.
Okay. Yeah, this was the one thing I needed them to change. However, I wish and I hope that this is actually. I'm just going to skip really quick because I want to be able to see if they did this for every quarter. Doesn't look like it.
Yeah.
I wish they did that retroactively, like for the last 2-3 years. Oh, actually, did they? No. This is still better, though. What are your guys' original thoughts? First thoughts here.
I
Seems
haven't looked
good.
at it enough. I'll let Roy roll with it.
I mean, we've just had a short glimpse, and for some reason it's not popping up on my end, so I'm just looking at your screen. But yeah, it looks good so far.
Steve, how you doing?
Good, you?
Doing well. Looks like they put in $2.5 billion of free cash flow.
Yeah, and the stock, the market's dumb. If you look at guidance, this is just, I'm gonna have to buy more, I guess. I don't know. This is depressing.
You get used to it.
They're gonna buy the whole company back in the next 11 years. It's just ridiculous.
Yeah, maybe.
Actually, much more importantly here is adjusted free cash flow. Actually, this was a one-time expense.
Yeah. From KKR and Happy Returns.
Right. In the last 2 quarters, they saw much better adjusted free cash flow as compared to real, GAAP net cash or free cash flow. But this time, it's actually the reverse. They saw a bunch of improvements because of KKR. Operating margin. Okay. What I need from someone, can someone share this and go through the presentation? Because I need to just start plugging numbers into the spreadsheet. That way I have, like, Roy, can you do that?
I mean, I don't have it pulled up, but
I don't either. I was looking for it.
it's not coming up for me for some reason.
Yeah. Well, let me see. Maybe it is now.
Go straight to their quarterly results and
Yeah,
just refresh.
Their investor relations side.
Do some
there.
things. Financials, quarterly results. Okay.
I mean, is there anything in this to be mad at with 24 guidance off the bat? 5 billion repurchases, 5 billion free cash flow. I mean, EPS non-GAAP of 510.
I think if you call yourself a growth company, you should be seeing, better than expected revenue growth. I think it's really putting people into perspective that they're keeping that valuation. There's not an acceleration here, which is what I would call a growth company. But a lot of it's going to be on management commentary as well.
They should have implemented a dividend.
So what was the share buybacks this quarter?
Did they take that slide out?
Share repurchase. Well, that's the guidance. So yeah, they're reiterating their buyback at least 5 billion. I don't see it other than just a reference to non-GAAP EPS expansion.
Okay, we may just need the 10K. Where's the stock at right now?
It is down 2%, so it's not crazy.
Yeah.
I've got.
I don't know what the streets saw at the very beginning. I guess they just saw the revenue beat and then just poured in and then went, oh, wait, never mind.
It's all algos, man.
It might have been the free cash flow as well, not realizing the adjusted figure, because it did the same thing in quarter 2 where it just tanked right out of the gate, but it just continued to tank at that point. And so I was like, there may be an algo blip. I was thinking just because they're algos, they're only as good as people program them. So
it's a double beat. I mean, they beat on EPS by 12 cents and they beat by 130 million on revenue. It's not like they missed.
I'm seeing that
that continues to generate tremendous profitability. I mean, this valuation's crazy.
Oh, from a non-GAAP EPS.
Tanner, you want me to take over the snapshot and you can plug in numbers?
Where are you? Here. Thank you.
Yeah.
Yeah, it's the 24 adjusted EPS of 510 versus 549 that they're probably hung up on.
Let's look at that.
Okay, now that I got my spreadsheet, I can tell you guys how everything did.
Yeah, here's the guidance. So quarter 1 guidance, main thing is the financial year 2024, in line with prior year, financial year non-GAAP guidance of 510. So that is actually a little bit lower. than expected. Non-GAAP EPS effective tax rate doesn't really matter too much. Free cash flow approximately $5 billion. So that's actually not a huge increase there. It's about the same actually. Share repurchase $5 billion is reiterated there. So approximately 360 of GAAP EPS, which includes a 24-cent benefit from the sale of Happy Returns in Q4 2023.
I called that crap. Yeah, transaction margin improved quarter over quarter from 45.4 to 45.8. That's
So
the
how about
inflection.
this? You guys see Disney? Disney missed on revenue and beat on EPS, and they're up 7% right now.
Lol. That's funny.
How ridiculous is this?
Yeah, I don't know. So here's the transaction margin slide. So of course we see revenue, non-GAAP, transaction margin, and that is something that's actually very, very important. And so you can look, they do a good job of showing the trend. 0% is actually really good. So $3.6 million right there, transaction margin, or 3 billion, 3.6 billion, not million. That would be really, really bad. Everybody sell at that point. So yeah, non-GAAP EPS actually came down just a little bit. I think they were expecting 21%, if not mistaken there. So that one came a little bit light.
Transaction and credit losses. This is something that I wanted to talk about for some time, is at multi-year lows. This is one that if it continued to climb higher and higher, would have been a real problem. If people believe in what PayPal is saying, that their AI is going to be able to detect fraud and detect losses faster than expected, then we would have to believe that that number would come down as a percentage of the total amount of transactions that are flowing through the system. That is what's happening right now. So yeah, very good, because last quarter and the quarter before that, it was trending the opposite direction, which would be counter to the thesis. So they're doing what they're saying they're doing, right? So yeah.
In November, I don't remember where I found it, but there were some talks as far as them tightening those standards, that they under Schulman had loosened them way up. And so part of that, it didn't just change under Alex Chris, but I think Schulman actually realized that he needed to change that, was to tighten their standards. And so we see it mentioned right here, this credit loss, negative 32% or minus 2 basis points. That's good, driven by tightened organizations and PayPal Business loan portfolio. So they're increasing their standards. They're, of course, continuing to use and have better implementation of their own data, and then externalization of the European buy now, pay later loan portfolio. That was a KKR deal that, was wrapping up last quarter, officially wrapped up in Q4. So basically, if people default in Europe, they've already sold those loans. So it's like, it's all right. If it's paying for, PayPal is still having those, but anything that's longer is a KKR. So just externalizing those potential dangers. And then this macro, that's a big focus of a lot of these payment companies. So those are the nitty gritty. I like the breakdown.
Yeah, sorry, I'm just plugging every number in, trying to look at their.
So we can see this is expected right here. Active accounts are down a little bit. They told us that this would be the case. So it went from 428 million to 426 million. That's a 2% loss. So a little bit steeper than last time. Most of what's going on there, what they've said is that in the past, their prior metric under COVID was just to get as many active accounts as possible. They didn't care what it cost, how much it cost them, what the benefit was. They just wanted to increase that number. And that's one of the things that Chris is changing is, these sort of metrics, they don't matter if you're not making money. So they've, in Latin America, there was, I guess, quite a few subsidies where they're basically paying people to use their product. At this point, they've removed the subsidies. They define an active account as someone who has made a PayPal transaction in the last year. So these will slowly roll off. They did say that this will inflect, at least in the last earnings, that they'll inflect sometime in 2024. And I hope that they elaborate on that. I'm sure that they will. But we never had this monthly active accounts. And the really interesting thing to me, well, it was Christmas. Grain of salt, but yeah, 218 to 224, that's good.
It's the highest number on there. So
yeah. So it's showing that these inactive accounts that are rolling off are just ones that just haven't really contributed much in a while. It had been when they announced that maybe 9 months, 10 months, 11 months. So it wouldn't surprise me. Of course, this is Christmas. So let's look at Q4. Actually, yeah, it's a bigger increase than what we had last Christmas for the monthly.
Yeah, all the rest look good. Number of payment transactions, record number.
Mhm.
Transactions per active account, record number, showing that the people that are still there are using it more. And
But that,
unbranded processing is sitting high too.
oh, got you. Okay, never mind. Oh, I'm good.
So I think my question right now to you guys is, do you think that the street is going to punish it further? Do we think this is dead money, or do we think that this is something that they can build a narrative off of?
Have to hear that
I
roadmap.
I always wait until the earnings call. Like it's right now, nobody's doing. It's only down 2% right now. The earnings call is what's really going to matter. Can Alex paint a solid picture of the future of this company? Can he make some promises that people believe? Is he going to set some checkpoints where he updates us, not just in earnings calls? Like, what do people feel confident on the path forward? And I think the conference call is going to be a big deal.
I want to be shocked. I want to. I think all of us shareholders want to be shocked.
Well, if I lose a bunch of money, I'll be shocked. So he'll have that going.
Yeah.
I love this breakdown though, that we can actually see, and here's where you can actually see the quarters, Tanner, with each of these. So U.S. total payment volume, not per products, but you can see peer to peer right here. That's mostly Venmo. Oh yeah.
Yeah.
More.
That's good.
There you go. That's cleaner.
All right.
Disney
So
is up 8% as the company raises outlook.
Yeah, it's all about that forward guidance.
Yep.
All about the forward guidance, and we can't buy enough shares back.
Look at international. International total payment volume up 22% year over year. And
that's cool.
Keep in mind, the macro has not been good internationally at all. And the dollar has been very strong. So that's been hurting them. They grew 22%. That's really good. Cross border.
I want to see that take rate go up.
Yes.
That's the thing I want to see. It's been trending down for like 2 years. I'd like to see the take rate going up more and more and more. And I think that's the stuff he's trying to target, right? He's trying to make sure that it's easier for people to complete payments, that there's an incentive to use the system. So, I mean, that's what he's targeting. So hopefully we start seeing improvement on that in Q1.
Yeah, and we do, from quarter 3 to quarter 4, the 1.91 to 1.96, and then the transaction take rate 1.72 to 1.78. So it has inflected, it is improving, but we got to keep seeing that. So
yep, it looks like it's actually starting the path of inflecting.
Yeah, the thing about take rate is that's the amount of money that PayPal is allowed to ask for per transaction, right? So
sure,
they don't really show authorization rates or conversion rates completely, which to some degree would be next level transparency. But you don't even really see that from many other payment companies either. So that would be one that I think is very hard for them to continue to climb up. Like, I mean, what a great ability to turn that over. But how do you continue to grow, Venmo TPV and Braintree and continue to bring that number up? Because both of those have lower take rates than branded checkout. So the only way to do that is grow branded checkout faster than the other sides of the business, which, I mean, hey, as a shareholder, I would love, but that would be a very hard ask.
Sure.
Let's see here.
Got to go a little to the left so we can see it all. There.
Yeah. Yeah, the transaction margin here. I love the breakdown. It's actually a lot easier to read, a lot more clear. It's not as pretty. They don't have as many graphics and everything. But honestly, if they do this and then they also break out another one of the graphics if they want to get fancy. But this is actually very much like Intuit. It's like, here's the Excel spreadsheet of the numbers. There you go.
So, yeah, and it's probably good for analysts, right? So
yeah,
that's going to make analysts happy. They'll feel like they have more insight into the company, just like we do.
So, I mean, all in all, I am not too discouraged by what I'm seeing. I like the inflection on take rate, on transaction margin. That was the number one thing. I think the problem is are people having a hard time distinguishing between something that is sustainable, or is this a holiday benefit? The part of being a seasonal business like this is that you don't know if a lot of these providers are necessarily, or a lot of these transactions are sustainable. Are we going to see growth quarter over quarter from Q4?
Well, as far as the transaction margin, I think we can answer that. They actually mentioned some things in quarter 24, in the quarter 4, 2024, that would actually make transaction margin unfavorable. That their actual expenses were just higher. It was just that time of year. That's the way it was. And we can see here, quarter 3, 2022 to quarter 4, it actually fell anyway. So if it's a seasonality thing, it didn't work last year in 2022. And yet we see it inflected. Like, this is completely unexpected. But I think that you're right, Tanner, that the market maybe is like, okay, why did it actually inflect? What's going on? Is this actually sustainable? Is this a one-time fluke? You know, one time it can happen. But 2 times in a row, you start to see a trend and you say, okay, that's actually really interesting. So you can just see it deteriorate here. This is the first time that it's actually improved in over a year. So that's meaningful, significant, and this is what most people are focused on. So really good so far. I know the reaction is whatever. I don't know where the stock is right now, but
down 2.5%, so nothing crazy.
Gonna need some more AI in this earnings call.
Yeah, say AI 100
Pump it
times.
up.
I don't know if that works anymore.
No, it never works anymore.
No,
it used to. You said it like 100 times. You were going up 20%, but I think those days are over.
Yeah.
Unless you're NVIDIA.
Gap.
Okay.
Hey, when does the call start off?
It's at 5 o'clock. I'm continuing to refresh it, but I'm not even getting to music yet, which means it's not even 15 minutes out yet.
Okay, cool.
Yeah, that 8 billion is just a lovely number. That's a pretty good beat. And I know that you'll go over the comparables. GAAP operating margin at 21.5%, non-GAAP operating margin at 23.3%. You can see those are higher, both at transaction rate, and they're being more operationally efficient, and that'll continue to improve as the impact from the layoffs hit. Some in quarter 1, but significantly in quarter 2.
That's when we'll really start to see those numbers add up. I wonder if they're going to look at doing more too. It seemed like he was trying to clean up the company and get rid of the parts that aren't profitable and don't make any money. So I'm just wondering if this is the first round or if there's going to be more.
Yeah, I doubt we'll find out here. He played it pretty close to the vest. If he may allude to continued efficiency and efficiency gains and the focus on being operationally lean and efficient. I think that he probably will, but probably more cuts are needed. I think it's usually healthier for an organization, especially like PayPal, to do them incrementally instead of let's lay off 10,000 people. They lost. Not everybody that they cut was just a trash employee that was lazy. I'm sure there were some that were bad employees that just need to be getting rid of, and some that were redundant. But there's some quality folks that they lost that are very good in this field. So if you go slower, you can really kind of take your time and say, okay, what's the impact? Did we have some unexpected impact from losing these folks that we need to make some shifts over? And then how are people actually performing in light of this? So, but it would not shock me if they continue to do a few cuts. The altimeter, altimeter or altimeter? How do you say that?
I say Altimeter Capital.
Altimeter.
Canadian thing.
Okay, yeah. I don't know. However you pronounce the name, I've only seen it written. So
just say Brad Gershner.
Brad Gershner. All right. So yeah, they alluded to.
I say Gerstner.
Sorry, of course you do.
Go ahead.
And you don't even get Venmo up there, so you can't speak into this.
Yeah, he's never used any of these products, so.
But yeah, they alluded to just needing to see a lean, mean PayPal, and I think that's what AliExpress will deliver. We won't know, we'll get a very good glimpse at this today, but as far as actual cuts coming, we won't know until the time that they actually hit.
But Roy, at the same time, this is a pretty lean, mean PayPal.
It much more so, yes.
It's a lot better already. Yeah,
a very profitable company, and I think my problem is they've been buying back so many shares, and it hasn't done anything for the street. Not a thing.
Yeah, I'm actually surprised. Like if from the Warren Buffett approach of just look at this company, don't look at the stock, and you value the price of the company. Operating margins look great to me. Non-GAAP operating margins look great. Take rate looks good. Transaction margins look good. Transactions per account look great. You can look at guidance and you can look at active account shrinking, which they said it would probably shrink to 400 million because they expanded too fast, too quickly in the wrong areas. So I've already cut off another 20 million off of that. I actually don't see the big downside here.
Neither do I. And I got to tell you, the amount that they have bought back over the past
So
5-6
much money.
years, I mean, it.
Roy? Or Steve?
Yeah, you there?
Oh, he just dropped off.
The
All right,
amount
we'll be
was
back.
so much that he is like, I'm getting out of this call and I'm buying
Yeah.
more right now. Probably.
Yeah, he's selling. Oh, here we go. He's coming back.
Oh,
So
sorry.
take freaking one or 1.5 billion, put that toward a dividend, and 3.5 billion toward buybacks. Actually, return capital in shareholders' pockets. We saw what that did for Meta. I mean, that was part of the reason they went up. I mean, this is a printing press for profitability. Hit it on all fronts.
Yeah, and they
Unless they
burned
wanna
almost
go
1 million shares since the pandemic too. So I mean, they're definitely buying back aggressively.
Yeah, I mean, unless they want to go private, then they should slow down and I never say slow down the buybacks, but it's just not working.
What is their? That's one thing I didn't see yet. What is their total share count that they used this quarter?
If the source I'm looking at is right, it's 1.077 million shares. So 1,077. And it was previously like 1173 million, so 1.173 billion shares. It went down a lot. And then is the net income, am I reading this right? I'm not looking at the PDF. Is it 1.604 for this billion for Q4?
Bear with me here. I see 1402.
Oh, okay. Maybe this is
Non-GAAP.
yeah. Okay.
Coach.
Yo.
Neil.
Hello there.
Ladies and gentlemen, we got Neil here. Neil, what is your original reaction to these numbers?
To be honest, my biggest surprise was transaction margins actually not being down. I was
Yes.
I was scrolling directly there. And I was like, hey,
Yeah, right.
Yeah.
Tanner was right.
I stuck with it. I believed in them against all odds. And how am I rewarded? Friggin' stock is down anyway. I don't get anything.
Yeah.
yeah, how much are we down? Because when I checked at
2%.
first, it was up 8%, and then everything disappeared.
It was
Yeah,
up like 10. It was up like 10, and that lasted about 30 seconds, and then it was down by like 5 or 6%, and now it's down 2.5. So it hasn't really went anywhere. I think everybody's waiting for the call.
Yeah, I think it's like a Microsoft scenario from previous years where basically the call does the whole movement.
Better perform, Alex.
Yeah.
Better
yeah.
shock the world.
Yeah, right. But yeah, it went up. If I look at the 4 hour here, it was a sweet wick up. I got excited. And then it was right back down. And then it was right here. So
honestly, that big up, like if you had told me that the gross margins would actually inflect, I'd be like, well, yeah, it might go up, maybe up to 10% or 8%, something like that. And I don't know what they don't like here. It looks really good to me. And that's a huge surprise. That's the number one bear argument against the stock, is that the margins will continue to compress. The competition is slowly killing it, and it's going to die a slow death, as the boa constrictor effect.
I think the algos are looking at guidance. Like every stock that's been going up, if you've got good future guidance, you're going up a ton. If you have weak future guidance, you're getting crushed. And with these guys, it's like, okay, it's already down 79% from the high. So, I mean, it can't get much more crushed. So I think it's just a wait and see.
Yeah, I mean, I'm curious over this last little bit, what does Alex Chris even need to say here? Like that potentially he's not already saying with guidance. What do you guys think?
Yeah,
I think it would be helpful.
Specifics.
Yeah, go ahead, Neil.
No, I believe I've been being a bit more specific because it was all about transparency and stuff like that. So now, like, we got our guidance, but not that much information, to be honest. I mean, it's the guidance we're pretty much used to. But yeah, we'll see. I definitely would like to see more info, how they get a bit more profitable. I believe the words cost cuts would be very much appreciated by the market, unfortunately, but
Totally.
let's see.
Do you think we have more
Well,
layoffs to come?
I hope so.
I mean, to be honest, do they need that many? I mean, it's not nice to say, but I don't really think they need that many employees to run a PayPal.
Me too. And they don't need duplication of platforms. They need to consolidate as much as they can. It's better from a coding perspective, from deployment perspective, like everything. I came from a background where I was a project manager for a software company. One was for an urgent care, the other one was for like a CRM type product. And the thing I hated more than anything is when there was products that were duplicated effort, but had separate code trees and separate developers and separate teams that manage them, and from marketing to everything else. And it's like, all that crap needs to go away. This company needs to be mean and lean. They need to pull a Meta. They need to cut. They need to consolidate products. They need to make it to where their mobile app doesn't suck. They need to make it to where, like all the things he talked about in that merchant video, there's so much good stuff in there. They just need to make it easy to use and make it to where merchants want people to use it. Maybe tie in the stable coin in some way and make it to where, again, if you could get merchants to where they're not paying high fees and you're undercutting Visa, MasterCard, all this other stuff. In parts of Asia, they don't even know what credit cards are. I mean, everybody uses QR codes for everything they buy. There's no reason why we can't be that way here. They need to push the future forward. And I think Alex is the guy to do it. So I'm hoping he says some of that in this call. I'd like to see him be spirited and excited and provide some good guidance on what they're doing with the product.
Now, I know, Jesse, that you, and probably correctly, assumed that whenever he meant shock the world, he didn't mean on, I think it was January 6th, something like that.
Yeah, that's a good marketing video.
Yeah, the last month. It was pretty early on. And so they did, the 6 new innovations, didn't catch any steam. Stock went down on that news. People weren't happy. Do you think that people are going to be more worrisome about his wording in this video or in this earnings call, that potentially his, bark is maybe worse than his management bite?
Yeah, I think he should not say shock the world in the video. I think he should avoid that particular phrase completely. But I think if he gives some vision of what they're doing and even a rough timeline of accomplishing goals, and talks about, like in that CNBC video that I was telling you about, that where there's like a clip that they had on CNBC, but it cut off a bunch of the good stuff, where he talked about a single platform and consolidating like the PayPal side and the Venmo side. I would love to see just the market right now. All they're looking for is, okay, great, you let some people go. Things are starting to look better. Transaction margins are getting a little bit better. Don't like forward guidance a lot, but tell us what you're going to do with this company to transform it so that we can start to understand your message and where this is headed, because it's begging to take off. The S&P today, new highs. NASDAQ, new highs. Dow Jones Industrial, new highs. This thing wants to fly. Right now, it was all about the large caps and evidently about Enphase and Disney or something. But this thing wants to take off. It just needs a reason to. And as long as the macro holds up, if he gives them that, I think we'll go higher. And we're just waiting on it. I don't know if I answered your question. Don't even remember it anymore. So
no, I just appreciate your commentary. Roy, any last thoughts before we get into the earnings call over the next couple minutes here? I have it. Music's playing, so it'll come up the second I hear any voices. So don't worry about missing it. We have it all prepped. But yeah, Roy?
Beyond what we've already talked about, what we'd like to see and hear, I want to hear about that margin inversion. Was this the low point that Alex Chris is saying that we were at, that Q3? Are we going to continue to see this normalize and get back up to where it was? What's going on with there? And I think that's what the market is most excited about.
I'm trying to look for gap sales and marketing. Did they even post that? Okay, here it is. Because they're really showing off their non-gap numbers, but I don't usually track those. Yeah, sales and marketing went up this quarter. Technology and development went up this quarter. Transaction and credit losses jumped pretty far down this quarter. Hopefully they speak on that, because if that is based on new technology that they have that is potentially catching some of these losses, or is that just because you're dumping potentially a lot of your credit? Like, but it's as a percent, it was lower, so it doesn't even matter. I'm curious. There's lots of unanswered questions within this so far, so hopefully that is brought up in the earnings call. I think it's kind of hard whenever you have sales and marketing that went up quarter over quarter, and you're seeing decline in active accounts. It's probably because there was going to be a decline anyways, probably larger than that, and they filled some of the gap, but it's still not enough for how many new people that they took on in certain areas of like Latin America. Like they were just doing a ton of advertising in Latin America, and these people are like, all right, I'll sign up and get $10. I forget what the sign up rate was, or the sign up bonus. They were taking it and they were never using it. They'd use it once and never again. And that was a Dan Schulman problem. Hopefully Alex Chris is trying to change those ways. But yeah. And no buy now, pay later numbers, correct? I didn't see anything there.
No, didn't see one either.
They regard that as a vehicle to actually sell branded. So I don't know if they'll break that down. It would be nice, but yeah, it's not a shock there. Yeah, transaction expense was up 0.97% instead of 0.93%, where it had basically been flat, as they expected. They'd guided for that. So,
yeah.
It's going to be interesting. I mean, I still believe more cost cuts are needed. If you look at the numbers, I've seen an article talk about their customer support and legal teams are in the thousands of employees. I mean, do you really need that in the age of AI, where AI bots can answer the most basic questions and handle some cases? I don't think so, but
yeah.
And there's a lot of regulatory compliance stuff and staff that they need. And honestly, that's where AI can excel as well. Those large language models can help quickly digest and go through information. And you need to, maybe use something like Palantir just for the KLM.
I was going to say that exact same thing.
Do it. You know it exists, Alex. You're with Intuit. You know it.
Yeah.
But no, seriously, like they can't get rid of everybody. They need a lot of people for that. But those people that they have can be a lot more efficient. And so I think they can for sure be leaner. I was laid off in 2008, so I know it's not fun. It stinks. I don't love it. And we can't just assume everybody's laid off was just a bad employee, but probably more cuts are needed.
Yeah, I really am not too discouraged about anything I'm really seeing. Cross-border TPV this quarter was a little bit weird. Oh, sorry. No, it wasn't. I was looking at the wrong side. No, it wasn't. No, it was great. I was looking at Q3 2022 because I don't like whenever things are sorted this way, like in order. I want it in reverse. I want the most recent quarter to be the closest to the column.
Yeah, that threw me off too, and I was like, "Oh man, that's actually a really good trend."
It's gotten so much worse.
No, cross-border, like this is what Visa has been saying. MasterCard, I believe, said the same thing. There's a couple other players that said it as well, that those are looking actually very healthy. And we can see that increase in improvement for PayPal as well. So, yeah, if the macro holds and it's good, like that was the biggest scary piece for me for PayPal going in, was if the macro just fell apart, PayPal would not do well. So that looks really robust.
Yeah. Growth 8% year over year. Nice. Love it. The call should be coming up pretty shortly now. I still have it hearing their beautiful little music playing, so we're just going to have to wait it out. Any other things that you guys had seen that potentially we haven't spoken about yet? Anything?
I think so. Anything?
Bueller?
Neil?
Bueller?
Roy?
Yeah, I'm just looking through it. So I've been saying things as I've noticed them. So
yeah, I have to get used to the new presentation and stuff like that.
Exactly.
What do you think? Like first reaction to the new layout, all the numbers, all the breakdown?
Well, first reaction was like, okay, damn it, where is all the info? Which slide is it now in? But no, I like it. There's now way more information, because previously you got a lot of of these partnerships with Starbucks or Amazon, or well, no, not
Yeah,
Amazon anymore.
pointless crap that no one cared
pointless
about.
stuff that just filled up with nice. Now we get more info that we'd like to see. I mean,
Yeah.
especially slide number 9 of the presentation. You've got PayPal branded checkout, PSP, Venmo, P2P Venmo, other merchant services, eBay, all laid out quite nicely. I like that much better than just having, oh, we have a partnership with Starbucks and Venmo, blah, blah, blah. Okay, cool, but we don't need that.
That was even the thing with their total amount of transaction volume before. They would just show off what it was. And then in the very corner in their notes, they'd say, Venmo grew to 68 billion this quarter. Like, I'm sorry, but even just saying 68 billion is not enough for me. I spreadsheet out everything. I want to give me the number, let me see the actual number.
Yeah, I mean,
I don't want anything rounded.
So, like, for example, we saw the numbers just from the Cyber 5, the big 5 days right after Thanksgiving through Cyber Monday. And it's great to see that. But if we don't have a comparison to where they were at before, it's like, cool, I guess. Like, it doesn't mean anything yet. It's actually seeing that trajectory, whether it's improving or getting worse. But this is really neat. The principles for value creation, that slide and 4. I don't know if these are the 5 KPIs that he's talking about. So start with the customer, focus on profitable growth. Like, for me, KPIs all need to be measurable. He does mention setting measurable goals and communicating consistently. So
yeah,
I'm sure that, since this is like front and center at the very top of the slide, there'll be some talk about that. So
someone said ARM. Yeah, ARM's up 40% after hours.
Wow. Ooh, there it is. Summary. Priorities for driving focused execution in 2024. Right at the end of it on slide 3, operate more efficiently. So I like that word. Keep saying it. Keep doing it. Unlocking the power of data to create more value for our customers while tapping into new sources of revenue and margin. Very good. Like, that's the biggest thing. PayPal has this high quality data. They have it across millions and millions of customers and merchants, double-sided network, and they've really just not leveraged it as well as I think that they could have. So that's a change under Chris with a lot of those first look products.
Okay.
Did you guys see the Brad Gerstner post?
Yeah,
we covered it.
Yeah, I mean, he did mention something very important. Is the line where he said, one thing we will not do is stick around and try to change board of management if they lack the commitment. I like that. Puts more pressure on them to actually execute and do things.
Yeah, we were talking about that. He did that same thing with Meta, and it worked out beautifully. I mean, Mark Zuckerberg definitely took the hint and completely did a 180. And I hope Alex does the same thing.
Yeah.
If he knows how to do it, right? It's not like he's a proven CEO yet. Obviously, he did very well at Intuit. But I believe in the same thing that Brad's saying. Like, if there isn't a easily visionable turnaround in a reasonable amount of time, I'm not sticking around. Like, I want to see this company turn around, and I think that it's a good play for me just to see triple digits in the stock price. But I'm not an end all be all PayPal fan. I don't think that this is the end or this is where I think growth in payments will be. I just think that they're so unbelievably cheap right now that any improvements should lead to a higher stock price, which my belief is that we are seeing that, but guidance kind of took away all of that steam. Like you're saying, you're showing all these margins and they're all improving, and then you're saying we're growing by potentially 6.5% next quarter in terms of top line. So,
but I'll say this though, I sorry to interject.
Yeah.
Sandbagging on guidance at the beginning of the year when you're a new CEO probably is not a bad idea.
Fair. Yep. If it comes close, I mean, I agree that they probably shouldn't shoot for the moon and then not hit it. You want to be able to hit those targets, but doesn't look like a hard target to hit, in my opinion.
It looks like one of the changes, which may have confused some folks too, is that they're beginning to update their non-GAAP EPS guidance to include stock-based compensation and payroll taxes.
I saw that.
So it's good.
All the new hires, all those C-suites getting paid.
ladies and gentlemen, we got the earnings call coming up. Okay, let me share this.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question
All
and
good. Everyone
answer
mute up.
session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. I would now like to introduce your host for today's call, Ryan Wallace, Head of Investor Relations. Please go ahead.
Good afternoon, and thank you for joining PayPal's fourth quarter 2023 earnings conference call. Joining me today is Alex Chriss, our President and CEO, and Jamie Miller, CFO. We're providing a slide presentation to accompany our commentary. This conference call is also being webcast. Both the presentation and call are available on our investor relations website. In discussing our company's performance, we will refer to some non-GAAP measures. You can find the reconciliation of these non-GAAP measures to the most directly comparable GAAP measures in the presentation accompanying this conference call. Our remarks today will include forward-looking statements that are based on our current expectations, forecasts, and assumptions, and involve risks and uncertainties. Our actual results may differ materially from these statements. You can find more information about risks, uncertainties, and other factors that could affect our results in our most recent annual report on Form 10-K and quarterly report on Form 10-Q, filed with the SEC and available on our investor relations website. All information in this presentation is as of today's date. We expressly disclaim any obligation to update this information. And with that, let me turn the call over to Alex.
Thank you, Ryan, and thank you to everyone for joining us this afternoon. It's been a productive first 4 months. I'm pleased with what we've been able to accomplish in such a short period of time while delivering the solid financial results we will discuss today. More importantly, I'm excited about the foundation we're setting and the velocity at which we're executing as we enter 2024. Today, I'd like to walk you through the changes we've made to the structure of our company, including several key additions to our leadership team, give a clear roadmap for how we will be executing going forward, and share our strategic priorities for 2024. Jamie will take you through the fourth quarter and full year results in greater detail, but the headline is that we delivered a solid quarter during the most important shopping season for our customers. In Q4, we delivered 9% revenue growth on $410 billion in total payment volume. Transaction margin dollar performance was better than expected in the fourth quarter, and we continued strong expense discipline, reducing non-transaction related expenses by 9% year over year. Taken together with $600 million in share repurchases in the quarter, our non-GAAP earnings per share increased 19% year over year. While these are solid results, we know there is still much room for improvement, and we're committed to making the necessary changes to our business and how we invest and operate to get it right. One of the key changes I talked about in our last earnings call was ensuring we have an outstanding leadership team in place. It's important to me that we have a leadership team with a broad diversity of experience, deep operational rigor, and leaders with track records of success. I'm thrilled with the talent that we've assembled in the last few months. With Jamie as our new CFO, Isabel Cruz leading People and Places, Michelle Gill leading Small Business and Financial Services, Susan Carreri leading Global Markets, Diego Scotti leading Consumer and Global Marketing and Communications, combined with talented leaders who have risen within PayPal, we have a world-class leadership team in place to help the organization reach its full potential. Each of these leaders chose to join PayPal because they see the tremendous opportunity we have in front of us to reshape commerce, and they're already driving a renewed energy within the company. Second, we've organized our teams around the customers we serve, consumers, small businesses, and enterprises. This creates clear lines of accountability and will enable teams to focus on delivering the right solutions that address our customers' greatest needs. Regardless of the customer we're serving, we want to make the PayPal offering so user-friendly, so rewarding, and so integrated into a customer's life that PayPal is the obvious choice. Our new structure enables that. Third, last week we announced that we will reduce our global workforce by approximately 9% through both direct reductions and the elimination of open roles over the course of the year. As I mentioned in our last earnings call, our size has been slowing us down. While this was not an easy decision to make, this change is necessary to execute with the focus and speed required to drive our next chapter of growth and allow us to invest in our future. With these changes, we continue to reprioritize and invest in the innovation and delivery of products and solutions that offer the greatest impact for our customers. The team has been very focused on building out our strategy and driving focused execution for 2024. These are the most important priorities we're focused on this year. Accelerating growth in our branded checkout business. Improving overall profitability, including that of our high-growth PSP services. Unlocking the power of data to create more value for our customers while tapping into new sources of revenue and margin, and operating more efficiently. Our first look customer announcement 2 weeks ago was an initial demonstration of the importance of delivering compelling value propositions to consumers and merchants. As promised, we're doing a lot of things to drive change internally and externally. However, nothing happens overnight. It will take time for some of our initiatives to scale and move the needle, but the initial customer reaction and merchant demand for our new innovations has been encouraging. 2024 is going to be a transition year focused on execution to position the business for long-term success. Our clear goal is to reshape the company to accelerate profitable growth and margin expansion in the years ahead. Prioritization will be key, allowing us to move more quickly and with better results. Later in the call, Jamie will take you through our full year guidance. We have made strategic decisions to reinvest cost savings back into our most important initiatives. It is critical that we remain on offense and position ourselves to not only innovate, but capture our share of the growth in global commerce. We want to be clear-eyed in terms of the potential near-term benefits from our initiatives, which is why our 2024 guidance includes minimal contribution from the innovations we recently announced. We want to see execution and clear results prior to embedding these initiatives into our financial outlook. As a company, we will build back a track record of delivering on our commitments. In November, I committed to being transparent with you all on how we will run the business. I want to spend a few minutes to share our operating principles and how we expect these will drive value creation over time. Our 5 operating principles are: number 1, start with the customer. I believe in working customer back. We will start by defining our customers and their most critical needs. Then we will use that knowledge to inform everything we do, including investments and innovation. Number 2, focus on profitable growth. We will prioritize high-quality, profitable growth and driving improved transaction margin dollars through more rigor and discipline. Number 3, drive operating leverage over time. We will combine our assets and data to develop more personalized experiences for our customers and drive efficiencies across the business to leverage our cost base. Number 4, set measurable goals and communicate consistently. We say what we mean and mean what we say. We will be transparent and accountable for our performance. And number 5, maintain a strong balance sheet. We will be diligent in managing our resources and returning excess cash to our shareholders. These 5 principles will guide how we make decisions and will ultimately keep us accountable to deliver what we say we will do. Let me now take you through what this means for how we serve our customers and what we're focused on in 2024. For enterprises, we're focused on accelerating growth in branded checkout and driving the profitable growth of our PSP services this year. Branded checkout is a critical part of PayPal's value proposition. We need to ensure we have our best checkout experience available to every consumer on every merchant every time. This will be a multi-year effort. To start, we redesigned our branded checkout experience, creating more simplicity and consistency with the goal of optimizing presentment, increasing speed, and minimizing friction across all major checkout flows. When combined with our efforts in passwordless authentication, these new flows can result in up to an additional 50% drop in latency, allowing a shopper to check out twice as fast. Improvements like this are aimed at driving a higher selection rate of PayPal and better conversion for our merchants. A challenge in the past has been bringing existing merchants onto our latest integrations and experiences. This is one of the reasons why our new guest checkout experience, Fastlane by PayPal, is so exciting. It's truly differentiated and will provide a compelling reason for merchants to upgrade. With it, we can recognize up to 70% of guests visiting a merchant, reduce checkout time by up to 40%, and grow the top of our branded checkout funnel. BigCommerce, one of our longtime partners, has already implemented Fastlane on their platform, and the conversion of their merchants using this new solution is as high as 79%. Combining solutions like Fastlane with a full suite of PSP offerings and more targeted, personalized commerce experiences creates a powerful end-to-end suite of capabilities that drives higher sales for merchants and gives them more reason to choose PayPal. We're focused on driving profitable growth, including within our PSP services like Braintree. The team continues to earn market share and merchant confidence through product and performance enhancements, delivering auth rate improvements of up to 240 basis points for enterprise customers in the US. We're continuing to build out and seamlessly integrate additional value-added services in areas like orchestration, routing optimization, payouts, and risk as a service, in addition to serving as a seamless integration point for our latest branded checkout experiences, including PayPal, Venmo, and Buy Now, Pay Later. We will be able to compete in the market with a best-in-class offering and price to value. In addition, we're putting greater discipline into our go-to-market and renewal processes as we focus on profitable growth. These areas take time to scale, but we're laser focused on them and expect to make steady progress this year. For small businesses, we're on a journey to move from a variety of standalone products to a modern platform with a comprehensive suite of solutions. What this means in 2024 is that we're focused on accelerating the adoption of PayPal Complete Payments, or PPCP, through a reinvigorated go-to-market approach for partners and developers. This full-stack solution enables us to distribute our best branded checkout flow to SMBs while also competing for the approximately $750 billion addressable market of processing volumes. We've had limited penetration of SMB full-stack processing to date due to the lack of a strong product, but that is now changing. November and December were record-setting months for new SMB adoption of PPCP. We're seeing lower churn rates for merchants on PPCP year over year, and we've also seen increases in transaction volume for merchants migrating to full-stack processing from our legacy products. As the year progresses, we intend to drive additional adoption through partner channels, targeted marketing, and developer-friendly capabilities like low and no-code integration paths available through our brand new developer portal. Over time, we want to better serve other important SMB needs, offering more ways to help them connect to new customers. It's also worth noting that all the checkout improvements I just discussed as part of our enterprise strategy can also benefit the tens of millions of SMBs that use PayPal. For consumers, we're focused on differentiating our value proposition, deepening existing relationships, and giving shoppers more reasons to choose PayPal. PayPal already has strong consumer awareness and trust, but that is not enough to compete in today's world. Part of a person's decision to choose PayPal comes down to presentment, ease of use, and speed, areas where we still have room to improve. We also want to give consumers more reasons to choose PayPal by delivering personalized and rewarding shopping experiences that also drive higher conversion for merchants. This year, we're launching and evolving a new PayPal app to create habituation. We will also leverage our merchant relationships and the power of AI to make the entire shopping experience personalized for consumers while giving them control over their data. In addition, we will drive increased understanding and awareness of why PayPal via sustained marketing efforts. Our goal is to drive quality customer growth over time, as well as deeper relationships that include more frequent use and a greater range of product adoption. The new checkout and app experiences we are rolling out this year will also create an engagement loop that will drive higher awareness of the various products we offer and drive higher adoption of our portfolio over time. Let me give you two examples of where we have significant opportunity to drive increased adoption. In the US, we have over 27 million active accounts using PayPal Rewards. In the fourth quarter, Rewards accounts had higher engagement and average revenue per account that was almost double that of non-Rewards accounts. The average revenue per account of someone who adopts the PayPal Cashback MasterCard is about 5 times higher than the average checkout-only account. Today, only about 2% of active accounts have that card in their wallet. Increasing adoption of these products will not only drive a richer experience for our customers, but improvement in customer engagement and lifetime value for us. Redesigning our app and creating improved, frictionless onboarding paths are tangible ways that we plan to drive higher penetration of these types of products. We're also bringing more functionality and better experiences to Venmo this year, like the ability to connect consumers with cashback offers from small businesses in their local communities. In addition to this innovation, we're focused on driving adoption of the Venmo debit card. Venmo debit card holders are among our most engaged accounts and drive 6 times the incremental revenue than that of a P2P only customer. About 6% of our active Venmo customers have a Venmo debit card today, so there is significant opportunity there for us to focus on. Finally, this year we will demonstrate meaningful progress towards operating more efficiently. We've already consolidated many disparate technology services into common platforms, though we have more work to unleash the power of our data in service of our customers. We're simplifying and automating manual processes and investing in tools and services needed to drive productivity and innovation velocity. This will reduce cost and complexity, improve the developer experience, and give more reasons for customers to choose PayPal. For example, we're converging to a single merchant reporting system so that our merchants will get consistent and accurate reports, which will make a huge difference in how they run their business. Another outcome of consolidating platforms is that we will now see one view of the customer, which allows us to more effectively cross-sell the various products we offer. We will be moving at lightning speed and with the weight of the company behind each of these initiatives to deliver the best experiences possible for our customers this year. To wrap up, I am pleased with our fourth quarter results and the execution that the team delivered throughout the quarter amid an enormous amount of change. I'm excited about the year ahead and all the innovation we have in store for our customers. With that, I'll hand the call over to Jamie to take you through our results for the fourth quarter and full year.
Thanks, Alex. Good afternoon. First, let me say that I'm very excited to have joined PayPal. Our new leadership team is laser focused on our customers, and I am incredibly energized to see our team come together to deliver PayPal's full potential. Before I discuss our financial results, you'll notice several things different in our materials today. First, we've redesigned our press release in a more standardized tabular format designed to allow ease of use and better consumption of information. We have also included additional supplemental metrics in our investor presentation intended to provide greater transparency into our business. We will continue to evaluate these and other changes over time. I'll start with a summary of our financial performance. In the fourth quarter, we reported 9% revenue growth on a spot and currency neutral basis. For the full year, revenue grew 8% at spot and 9% on a currency neutral basis. Transaction margin dollars were flat year over year in the fourth quarter and declined 1% for the full year. Non-GAAP earnings per share were $1.48 in the quarter, representing 19% year-over-year growth. Higher earnings per share in the quarter were driven by ongoing expense discipline and better than expected transaction margin dollars, which benefited from branded checkout, Braintree, and interest on customer balances. We ended the full year with $5.10 of non-GAAP earnings per share, up 24%. Our full year results benefited from lower operating expenses, the higher interest rate environment, and the impact of share buybacks. Now I'll walk you through some key operating metrics that support these results. We ended the year with 426 million active accounts and 224 million monthly active accounts. Throughout last year, we indicated that we expected ongoing churn of unengaged accounts in less developed markets, predominantly in Latin America and the Asia Pacific region. This was the primary driver of our year-over-year reduction in total active accounts. We had modest growth in monthly active accounts, up 1% for both the quarter and the full year, and our active base of engaged accounts remains stable. More than 50% of our total active accounts were monthly actives over the course of 2023. Transactions per active account, which is a trailing 12-month number, was 58.7 in the fourth quarter, up 14%. If we exclude PSP processing, which is primarily Braintree from that figure, transactions per active account grew 7%. Part of this growth rate is driven by the churn of unengaged accounts that I just mentioned, but we were also encouraged by the higher activity levels we're seeing among our core base of accounts. Page 14 in our investor presentation includes additional information on our historical trends in monthly active accounts and transactions per active account, excluding PSP processing. On volume growth in the fourth quarter, we saw total payment volume, or TPV, of $409.8 billion, representing 15% growth at spot and 13% growth on a currency-neutral basis. This growth was driven primarily by Braintree, as well as branded checkout and Venmo. U.S. TPV grew 11%. International TPV grew 17% on a currency-neutral basis, primarily driven by strength in Europe and improvement in Asia. For the full year, TPV was $1.5 trillion, increasing 13% at spot and 12% on a currency-neutral basis. PayPal's fourth quarter global branded checkout volumes grew by approximately 5% on a currency-neutral basis, bringing full-year branded checkout volume growth to 6%. We have seen a solid start to the year with consistent global branded checkout growth through January. PSP processing volumes grew 29% in the quarter, driven by ongoing growth in Braintree. The team continues to make product and performance enhancements for merchants. We are also putting greater discipline into our go-to-market and renewal processes as we focus on overall profitable growth. With respect to revenue, as I noted earlier, revenue in the fourth quarter increased 9% on a spot and currency-neutral basis to $8 billion. Transaction revenue grew 9% on a spot basis to $7.3 billion, driven by Braintree and branded checkout. In the fourth quarter, U.S. revenue grew 8%. International revenue increased 10% at spot and 12% on a currency-neutral basis, accelerating from the third quarter. Similar to TPV, We saw ongoing strength in Europe and improvements in Asia. For the full year, U.S. revenue grew 9%, and international revenue increased 7% at spot and 9% on a currency-neutral basis. Other value-added services revenue in the quarter grew 9% on a spot basis to $743 million. For the full year, other value-added services revenue grew 26%, or by approximately $600 million. For both the quarter and the full year, this growth was driven almost entirely by increased interest income on customer stored balances. Transaction take rate declined 10 basis points to 1.78% in the fourth quarter. Approximately 7 bips of this decline was driven by 2 factors: lower gains from foreign currency hedges, which are recorded as international transaction revenue, and flat foreign exchange fees. In addition, mix shift with higher volumes from large merchants continued to have a slight impact on our branded checkout take rate. Transaction take rate for the full year was 1.76%, also down 10 basis points year over year. Transaction margin dollars were flat year over year in the fourth quarter, compared to a 3.5% decline in the third quarter. This approximate 4 percentage point improvement was driven by a combination of the absence of merchant contractual compensation in the prior year period and by branded checkout and Braintree. The growth of interest income on customer stored balances and growth of branded checkout were the largest contributors to transaction margin dollars in the fourth quarter. This growth was offset by the absence of hedge gains compared to the prior year period, as well as declines in other parts of the portfolio, including the impact of migrating and consolidating legacy PayPal payment services. Fourth quarter transaction expense as a rate of TPV came in at 97 basis points, 4 basis points higher than the same period last year. This increase was primarily driven by Braintree volume growth and was partially offset by a favorable geographic mix of PayPal volumes and rate benefits in Venmo. Full year transaction expense as a rate of TPV was 94 basis points. Transaction loss as a rate of TPV was 7 basis points for the quarter, up 1 basis point from the fourth quarter last year, and 8 basis points for the full year. Credit losses were $119 million for the quarter, or 3 basis points as a rate of TPV, down 32% year over year, and 3 basis points as a rate of TPV for the full year. We have taken a prudent and active approach to managing our overall credit risk, tightening originations within our PayPal Business Loans portfolio, and externalizing our European Buy Now, Pay Later portfolio. In the fourth quarter, non-transaction related operating expenses declined 9% as we continue to actively manage our cost structure. For the full year, the same expenses declined 11%. Non-GAAP operating income grew 11% in the quarter to nearly $1.9 billion, and for the full year by 14% to $6.7 billion. Our non-GAAP operating margin increased 40 basis points to 23.3% in the quarter and increased 110 basis points to 22.4% for the full year due to better operating expense leverage in each period. PayPal generated $2.5 billion in free cash flow in the fourth quarter. This includes a $1.7 billion net benefit from the sale of our European Buy Now, Pay Later receivables to KKR, partly offset by the impact of new loans originated as held for sale. Adjusting for this impact, we generated nearly $800 million in adjusted free cash flow in the quarter and $4.6 billion for the full year. Higher than expected changes in working capital and cash taxes had a negative impact on fourth quarter free cash flow. In the quarter, we completed more than $600 million in share repurchases, bringing full year share repurchases to approximately $5 billion. We ended the quarter with cash, cash equivalents, and investments of $17.3 billion and debt of $11.3 billion. Before turning to our first quarter and 2024 guidance, I have two updates to our guidance approach to share. First, for the time being, we intend to move away from providing annual revenue guidance and instead provide guidance for the upcoming quarter. Given the considerable changes underway at the company, we believe it is prudent to guide revenue one quarter ahead and provide updates as the year progresses. Second, the first quarter and 2024 guidance that we're providing today excludes the impact of stock-based compensation from our non-GAAP results. This is consistent with our historical approach. Beginning in the first quarter, we will include stock-based compensation expense in our non-GAAP results. We will update our reporting and guidance accordingly at that time. Stock-based compensation is an integral part of our cost structure and one that we believe we need to manage more directly and transparently. Including stock-based compensation expense in our non-GAAP earnings will introduce more accountability and discipline and will align our own performance measures to the way that many investors already evaluate our business. In terms of our outlook for the first quarter, we expect revenue to increase approximately 6.5% at spot and 7% on a currency-neutral basis. In addition, we expect non-GAAP earnings per share in the first quarter to grow at a mid-single-digit percentage. With respect to our full-year financial plan, as we have said previously, with all of the changes we are making, 2024 will be an execution year and one where positioning the business for long-term success will be critical. For the full year, we are planning for a relatively consistent macroeconomic environment with some level of interest rate declines as we move through the year. We also assume that overall consumer spending and activity levels will remain relatively consistent. We expect full year 2024 non-GAAP EPS to be roughly in line with prior year EPS of $5.10. Underpinning our outlook, we expect roughly flat transaction margin dollars. Alex discussed our innovation and product enhancements earlier. Many of these are already in pilot or launch, but will require execution throughout the year before we begin to see impact. Our guidance includes minimal impact from these initiatives. We expect a low single-digit increase in non-transaction operating expense. As Alex mentioned, we announced actions last week to reduce costs to drive continued efficiencies, while at the same time investing more in our product engineering and platform teams to drive growth. There are two factors to be mindful of that will impact our other value-added services revenue. First, while we are still seeing benefit from the higher interest rate environment, we expect that this tailwind will be much less significant in 2024. Second, we continue to take an active and prudent approach to managing our credit exposure. We are carrying lower credit receivables after tightening originations last year, and for our off-balance sheet originations, we are planning for ongoing normalization in loss rates, which will impact the revenue share that we earn. We expect free cash flow for 2024 to be approximately $5 billion. From a financial policy perspective, we remain committed to maintaining an investment-grade credit rating. Absent inorganic growth opportunities, we expect to continue allocating approximately 70% to 80% of our free cash flow to share buybacks. However, given our strong cash position as we enter the year, we are currently planning for at least $5 billion in share buybacks in 2024. That concludes my prepared remarks. I'll now hand it back over to the operator to begin Q&A.
Thank you. At this time, I would like to remind everyone, in order to ask a question, please press star, then the number 1 on your telephone keypad. We ask that you ask one question, then return to the queue if needed. We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of Tien-Tsin Huang of JP Morgan. Your line is open.
Thank you so much. Appreciate all the details here. I wanted to dig in on the outlook for transaction margin dollars to be flat. Can you just give us a little bit more, maybe high-level thoughts on the key drivers there and maybe some of the levers that are available to you to get the transaction margin dollar growth to accelerate beyond that in 2024. Get a lot of questions about it, obviously, so I'd love to hear the puts and takes that you would underline for us. Thanks.
Sure. Thank you, Tien-Tsin. First, let me start just with recognizing how much change there is that we've gone through. You heard it in my prepared remarks, but we essentially have a brand new executive leadership team. We've accelerated the pace of innovation. The first look experience you saw a couple of weeks ago really was innovation that could have taken months or years. That I'm very proud of the team accelerating and getting done in 60 days. And we are at a point now where even our mindset shift, this focus on profitable growth, is something that's new for the organization, and we are grinding away every day. And so, with that said, let me unpack the components of transaction margin growth. The way I think about it is there's three levers there. The first is really around the branded experience. This is a proven experience for us. It's one that we, in some of the innovations that we put out, both for merchants that improve their experience, as well as consumers with a new app that allows them to get through the experience better. That is a significant lever for us, and one that, to be honest, we've under-invested in. And if I take just specifically the mobile experience for our consumers, has been underwhelming. And it's something that, with the new innovations we just rolled out, I expect for us to be able to continue to see improvement there. The second is around the unbranded processing. This is an area that we have invested significantly in. With Fastlane now, we have really, I believe, one of the best products in the market for our merchants. We're seeing the highest conversion rates out there, and it's something that our merchants are looking for and looking to adopt. We also are looking to move into new areas for growth that have higher margin opportunities, such as international and small business. And it allows us to actually have different conversations with our customers and really price to value the product. And the third is really what I'd consider a bucket of value-added services. This is a combination of improving our flows with our consumers to ensure that we're attaching the products that we need to, whether it's buy now, pay later, or our cashback MasterCard. These are flows that we've not optimized, and we're underperforming when it comes to really attach. And then some of the new offerings that we rolled out. You saw our advanced offerings platform, as well as smart receipts. These are all ways that we can monetize and improve the connection between our merchants and consumers. So that's different ways that I think about the components.
Yeah, and Tien-Tsin, I'll jump in on the 24 specific puts and takes on transaction margin dollars. And first, you heard us both say earlier that on the initiatives that Alex has been talking about, we have included limited impact on that in our guidance. But if I pull back, really, we're viewing largely steady trends to what you saw last year, maybe in slightly different proportions. So branded checkout being a healthy contributor to growth, improvement in our PSP margin profile. We expect some benefit in our interest income on customer balances, but really that should be much smaller than what we saw last year. And we do expect some headwinds to our credit revenue, which, as I mentioned in the script on the call, with loss rate normalization happening to pre-pandemic levels and that trend starting to work, we'll just see lower rev share from our partnerships in that space. And then offsetting that, we really see also that some of our smaller product lines in the aggregate will be a drag on TM. This will be to a much lower extent than last year, but in areas where we do platform consolidation, there are times we deprecate products to really push customers to new platforms. Good example of that is PPCP. We do see some drop off, and we've got a few other products that, as you know, we have not invested as heavily as perhaps we should have in the last couple of years. And as we work our way through that, there'll be some offset there.
Got it. No, that's helpful. Thank you both.
Your next question comes from the line of Jason Kupferberg with Bank of America. Your line is open.
Thanks, guys. Appreciate you taking the question. So I wanted to hone in on branded TPV growth a bit. I think it slowed by a point in the fourth quarter to 5%. Was hoping you could maybe take us through some of the monthly intra-quarter trends there, any market share observations you might have had from holiday season, and then just some general comments on what you're planning for on branded TPV growth in the first quarter and full year 24. Thank you.
Yeah, thanks, Jason. Let me set the context, and I'll see if Jamie wants to pile on. You know, our branded checkout performance was 6% for the year. It's been pretty consistent, and you know, for what we're looking going into next year, we're expecting it to be consistent as well. And as we've talked about, that doesn't include or includes minimal aspects of the new innovations that we put out there. Let me talk about just some of the levers when it comes to new innovations or ways that I think about accelerating branded checkout, because this obviously is going to be a big focus for the organization. The first is we really have to improve the value proposition for our consumers. This is why you see us leaning into rewards, ensuring that we've got an improved experience that reduces latency, and really leaning in on mobile as well, so that our consumers have a better branded checkout experience. Second, you know, the acceleration of Fastlane when it comes to our merchants not only improves the unbranded opportunity, where we can see 70% of the customers that come through the Fastlane experience, but allows us to have a second engagement with our customers and bring them back into a branded experience at a later date, show them all the different reasons why they should be using PayPal or getting a reward back for a purchase that they made. So I think these, again, are just a couple of examples of innovations that we're leaning into now that allow us to really focus on that branded experience.
Thank you.
Your next question comes from the line of Darrin Peller with Wolfe Research. Your line is open.
Hey, thanks, Alex and Jamie. Guys, just to follow up a bit on some of this train of thought. I mean, I know you're mentioning you're not incorporating these new initiatives in your transaction profit growth thoughts for this year. But when we think about some of these, I mean, most of these, to your point, Alex, are going to be beneficial to gross profit growth. And so I guess we'd love to hear a little bit more around what you'd measure as how you would measure success, whether it's the PPCP initiatives or unbranded, as well as the branded checkout experience. What KPIs should we look for? And I guess a little bit more on timing. If not this year, when do you want investors to expect some traction in actual gross profit reacceleration?
Yeah. Well, thank you, Darrin. And look, let me be clear. We are not putting in the expectations into the guidance until we see execution. We just think it's prudent for us to put points on the board before we put it into the guidance. That said, the teams are grinding on this every single day. We are having conversations with our merchants and introducing them. As I mentioned on the call, the reaction has been quite encouraging from the innovations. There is demand in the market, and we are starting right now. And I will tell you, the conversations that we're having now that we're focused on both innovations that are driving demand as well as improvements for these merchants are different than we've had in the past. So I just want you to know we are working now on this, and we will update you as we start to see points on the board and adjust our guidance as needed. Secondly, back to your first question around how I think about this. Look, the thing I want you to take away from all of this innovation that we rolled out in First Look is this is really changing the way we engage with our customers and our merchants. We are now creating experiences across the entire customer lifecycle, not just at checkout. So we are driving not only a checkout improvement, the 50% improvement in latency, being able to improve Fastlane, but now we're starting to see a customer value proposition with CashPass, giving rewards back to our customers so that they have a reason to choose PayPal at every purchase. We're improving the onboarding and the reboarding as they come back into the app and start to now attach our MasterCard or debit experiences or buy now, pay later. We're improving the post-purchase experience where we now have smart receipts or package tracking so that we can improve the engagement between our merchants and our consumers. And we now have an ongoing active use engagement. And then we're leaning into demand generation and actually solving the biggest challenge that our merchants have, which is finding new customers. As we think about our advanced offers platform, we're creating shopper insights so that our merchants can start to engage and personalize their experience through our data and through the AI that we can lean through. So the way I think about it is we are looking at the entire end-to-end experience, and we'll measure success through the metrics that you have. It's going to turn into what does transaction margin look like? What does active use look like from our ongoing users? So that's how we'll think about it.
Okay. Thanks, guys.
Your next question comes from the line of Michael Ng with Goldman Sachs. Your line is open.
Hey, good afternoon. Thank you for the question. I wanted to ask a question about PayPal's commitment to durable, high-quality, profitable growth. How does that impact the pricing strategy in Braintree? What unprofitable businesses and products will PayPal de-emphasize, and how does that tie into your 2024 non-transaction OpEx outlook of flat? Thank you very much.
Great. Thanks, Mike. Let me talk about Braintree, and then I'll have Jamie talk about potentially some of the other products and businesses. So let me take you back. Braintree, if you go back a few years ago, was really trying to establish itself in the market. It hadn't delivered at scale, and there were gaps in the product. We've invested heavily in the product and have really focused on some of the largest U.S. enterprise customers, which now have proven the scale while we've gotten the product to parity. Then you look at what we've just rolled out with innovations like Fastlane, and I think we've now leapfrogged the competition. So what does that allow us to do? It allows us to be the one-stop shop for merchants. It allows us to provide a best-in-class experience on auth rates and give them the ability to have not only the best processing in an unbranded, but also package that with PayPal and with all the other ways that customers want to pay, including buy now, pay later. We now are shifting towards being able to have a price to value conversation with our merchants and being able to really start to think about how will we ramp up go to market for not only Braintree, but also PPCP. We also are now moving into markets that have higher margins. So international and small business with both Braintree and PPCP allow us to now, again, price to value and have different conversations. So that is how we think about it. We're not focused on unprofitable growth when it comes to Braintree. We think we now have the product in market to be able to compete effectively and win.
Yeah, and Mike, on the other part of your question, I guess what I'd say is we are just doing too many things. And our biggest opportunity is that we have to make decisions to stop things and to really focus. And that gets into market competitiveness, it gets into pricing, it gets into really leaning into market opportunity and really stopping doing things that prevent us from doing the right thing in those spaces. So we are knee deep in that right now. And so when we talk about a year of transformation and execution, that's exactly what we're talking about.
Great. Thanks, Alex. Thanks, Jamie.
Your next question comes from the line of Ramsey El-Assal with Barclays. Your line is open.
Hi, Chris and Jamie. Thanks so much for taking my, Alex and Jamie, thanks so much for taking my question this evening. I wanted to ask about how much leeway or opportunity you have to continue kind of taking out expenses while simultaneously executing on the growth strategy. How are you thinking about striking that balance, sort of cost control versus growth? And I guess, how confident are you that you have room to do both?
Yeah, I would say that is definitely an and, not an or. And that's exactly what we're doing with the workforce announcements we made a week ago, and really taking that and putting that back into product, into engineering, and into marketing. We have got to invest deeply to grow this place. And it's really important for us to just set the company up for the future. And to do that, the innovation muscle, the commercial muscle, means that right-sizing our expense levels isn't going to be something that it's a one and done. We know we have significant opportunity to continue to be more efficient, be that through automation, be that through driving deeper productivity. And as we harvest that, that just gives us more levers to invest that are the right things for our profile as we go forward.
Got it. Okay, thank you.
Your next question comes from the line of James Faucette with Morgan Stanley. Your line is open.
Great, thank you so much. Jamie, just a quick clarification, and I have a question for Alex. But you said that starting from the first quarter, you'll be including stock-based compensation in your non-GAAP rather than excluding it. So does that mean that, if we just imagine that we fast forward a few months, that the non-GAAP earnings would be reduced by roughly that 1.8 billion? Just looking for a little bit of clarification there. And then, Alex, you made an interesting comment in terms of feeling like things are too big organizationally, but I'm wondering how you're feeling about the tech stacks right now and the level of integration and where we're at from that perspective in terms of your ability to drive the kinds of improvements and perhaps add functionality to improve the customer experience. Thanks.
Yeah, James, on your first question, you have it exactly right. So beginning in the first quarter, we'll start including stock-based compensation expense in our non-GAAP. And closer to that time, we'll do the look back where we'll provide, the retrospective data so that we've got everything on a comparable basis. But yeah, you're thinking about that right.
And then James, on your question around the tech stack, look, I'll be transparent. The company has gone through significant growth over the last few years and a lot of acquisitions. We have not invested enough in creating a single platform. That again slows us down when it comes to innovation, and it slows us down when it comes to being able to leverage the data across the ecosystem. We are investing heavily in that now and starting to see real improvement. I mentioned a couple of things on the call, but really being able to put out a reporting system that now sees across the entire ecosystem, being able to see a single view of the customer so that now we can provide innovations to customers, but also actually be able to cross-sell and be able to say, hey, this is a customer that has this risk profile and should be in these 2 or 3 different products is a huge win for us as we start to consolidate. It also just accelerates our engineering velocity. Being able to have a services-based engineering team that can build once and deploy across the entire ecosystem is the direction that we're heading in. And so you started to see that. Even the innovations that we just put out over the last couple of weeks weren't really possible without us investing heavily in the platform. But I also would say we have a ways to go. And so it's a primary focus for me and the organization, and will drive velocity and efficiency.
Your next question comes from the line of David Togut with Evercore ISI. Your line is open.
Thank you. Good afternoon. A major regulatory change in payments just went through in Europe with Apple opening up its iOS and NFC chip for physical point-of-sale payments. What opportunity does this present to PayPal?
Yeah, thanks for the question, David. We are tracking this closely. Apple is a great partner of ours, and our customers that love PayPal on the online e-commerce side are demanding being able to have an omni-channel and offline solution as well. So we'll be working closely on this, and when it is available, we will be ready to be able to deliver for our customers, both online and offline.
Your next question comes from the line of Sanjay Sakhrani with KBW. Your line is open.
Thank you. Alex, one more on the initiatives and just trying to think through the prioritization of these additional investments you'll be making. Of those 6 initiatives, which do you think will sort of yield the returns quickest, and maybe a little bit more on timing of them, maybe not 2024, but how early? And then Jamie, just a quick question on the interest rates. I think you mentioned you don't expect it to have a big impact or as big an impact in 2024, but is there an explicit rate forecast you have? Like, do you have lower rates in 2024? Thanks.
Thank you, Sanjay. So, all of the innovations are incredibly exciting for us. But let me be specific on your question. The 2 that I am closely watching and our teams are executing on immediately is really a focus on the branded experience. This is both for the combination of merchants and consumers, easing that experience for a customer to choose PayPal, have a reward that comes back to them, ensure that they're able to get through the experience with velocity and check out every time with PayPal is a huge focus for us. And that's where we are driving a new app experience. And again, all of these innovations will be coming out over the next couple of weeks to months. Then we have to drive adoption. So that is having conversations with merchants, ensuring that they're upgrading to our latest innovations. That's ensuring that we make it easy for them as well. So that's why you've seen us launch a new developer portal. We're creating no-code, low-code experiences so developers can take the demand that they've shown because they have a best-in-class experience now and get it into market. So step one is I'm very focused on that branded experience. The second one is around on the unbranded side, which is ensuring that Fastlane gets rolled out. That to me starts to create an interesting network effect of us being able to have not only a branded experience, but for then those consumers that pass a branded experience, whether it's ours or anyone else's, and want to just go through a guest checkout flow, we're able to identify them, we're able to help them and our merchants complete the transaction, and then we're able to have a follow-up conversation with that customer as well because they've gone through our Fastlane experience. So those two to me, we need to get rolled out. We need to get points on the board and show that it's driving, but driving outcomes. But that is where I'm most focused on right now.
Yeah, and Sanjay, on the interest rates question, we do expect that the interest income on customer balances will have some growth this year, but really it'll be more first half focused. The second half, we do expect a series of rate cuts that is assumed in our macroeconomic scenario that underpins our guide. And that's why the second half should be much lighter on that front.
Thank you.
That is all the time we have for questions. I will turn it to Alex Chriss for closing remarks.
Fantastic. Thank you, Sarah. And thank you all for joining us today. I want to reemphasize that 2024 is going to be a transition year focused on execution to position our business for long-term success. I'm excited with where we're positioned in the market, and I know that there is real opportunity to grow our role in commerce. We're driving the foundational and transformative changes that will set the company up for the future. Thank you.
Thank you. This concludes.
Well, I should have gotten a Celsius and a Red Bull and a Monster all together to survive this one.
No doubt.
You
Got better at the end.
That is summed up to a couple words that Alex Chriss is fully dependent on the faster checkout product coming out, Fastlane being exactly what he wants, improved cashback, and smart receipts. I thought they were going to talk about other things they're working on. And then every single question that kept getting brought up, he would bring up these 4 to 6 innovations that they talked about on something that they've already reported. That's why the stock is crashing. You didn't say anything.
Yeah, that's true.
Like, and then some of the things where they're saying, at least this is how I saw it. They said, there's certain products. He brought out some Dan Schulman-like activity, said, there's 27 million PayPal reward people. These people generate about twice the amount of revenue than other just peer-to-peer. Debit card users are 5x the revenue. Venmo debit cards are 6x the revenue. And then you boil that all down to, we expect mid 4 to 6% revenue growth for next quarter. And it's like, okay, that's all fine and good, but you're not expecting any of that. You know what I mean? So I think that's what's really making people upset right now in this earnings call. And I can see it too. It's just like all this, driving efficiencies is not actually translating to what you guys are guiding for. And there was a comment that I saw that I think summed it up. You're in a growth phase. Sandbagging right now, you're trying to turn the ship around. Sandbagging is not the option. So enough sandbagging, and let's actually hear what you guys are planning on doing to see a real turnaround here. I don't know. Roy?
And honestly, I really like the change that they made, for adjusted EPS to incorporate this SBC and the payroll taxes. This may not have been the quarter to do that, just because it confuses people, because they look and they're like, oh, you're doing the same EPS as you did last year, 0 growth. Well, they're factoring in $1.8 billion which already was coming out. Like it already existed in payroll taxes, SBC. It's a slightly higher SBC, which was expected because they're bringing on new people.
Right.
And so when people just look at those numbers, they're like, wow, it's not growing at all. I'm done with this. Of course, you're also not factoring in, just like you said, the first look products. This wasn't the quarter to sandbag, which I think they're doing. Like I don't see with buybacks, even including that 1.8 billion number, them not beating this guidance. Frankly, it's very, very soft, even with the macro, what it is and everything. So yeah, incorporate some of that. It would be okay to take a step out and say we think that this is what it's going to be, and then to hold off maybe a year out before you actually shift these things, so that people can actually see and understand. And even when an analyst had asked Alex and Jamie, like, hey, what's going on with that full year guidance? That would have been great just to say, hey, those numbers already reflect the SBC. Like it's right there in the footnote. I had to read it 3 times just to make sure. It says this is estimated non-GAAP amounts for financial year 2024 reflect adjustments of 1.8 billion, including all that stuff. So it's not just that they're going to start doing that this next quarter. That forward guidance already reflects it. And I don't think people fully caught it. If you're just looking at the headline stuff, it's like, wow, no growth at all. I'm done.
Yeah.
Totally.
Yep.
So, but earnings call itself, like earnings were actually good. I know,
But that's the
reaction
thing.
doesn't look, but the call was
good.
The
The
call was
results
horrible.
are
So
solid.
boring.
It was like
to
the
think-
opposite of last time.
To think a quarter ago, it was the most exciting earnings call we had seen. And then this earnings call, it was a repeat. And then even whenever people were asking Alex Chris about Braintree, in the back of my head, all I could think about is this guy doesn't even understand this product at all. like he's too new to understand, and he's really focused. Like he transitioned a Braintree question into fast lane checkout and all this stuff. I was like, this dude is just focused on these 4 new products. That's all he wants to talk about.
Now I think he should have kept the first look event for after the earnings. For after the earnings, of course, hindsight's 2020. But
Totally.
overall results were solid, guidance weak. I think this earnings call came maybe 3-4 months too early for them. There's still a lot of execution left for it to actually have a meaningful impact on the company. So I understand the people that are not happy with the way the stock is reacting, but yeah, there's not much they could have done. I mean,
Tanner, get your hand on your buzzer, because this was the worst fucking conference call that I have heard in so long.
Tell us what you really think.
This was the worst fucking conference call that I have heard in so fucking long.
You're doing really bad on the buzzer.
I'm trying to catch it, okay? There's a little delay.
You're not going to catch it, because I'm going to trick you, because you thought I was going to say fucking conference call then, but I said it now. You're not going to catch
There
it.
goes the monetization.
I don't care.
Ladies and gentlemen, I have lost monetization.
Good, I'll send you a check. I don't care. Listen, this guy needed to come out, and he needed to say, listen, we are a widely profitable company. The market is not valuing this company correctly. This is what we're doing. We are going to grow the company. We're going to grow profitability. And you know what? If the market doesn't like it, we'll take the company private. Like, don't come out and say, don't have your CFO say we're doing too much. Like, what was that?
Yeah.
Yeah,
It's
again,
like Tesla's conference call,
That
actually.
makes it seem like you can't manage your business.
Yeah. Well, I also think
And
all
then
the
don't say you don't have a good tech stack, and that you don't have like, what was that?
Oh, it does suck though. I was
Well, you don't
actually
have to
happy
say
you
it.
mentioned mobile. I was happy you mentioned single platform. It sucks. Like it needs to be better. It was a sobering conference call, and it definitely wasn't like super positive and exciting. And my calls are probably going to bleed out like 160K tomorrow. So I won't be happy about that part.
Home. Like this guy, I almost fell asleep driving home. That's why I dropped off.
Oh yeah, that part was
2
bad.
hours
It
further.
definitely, people were joking about the AI narrative, and then she came on, and it didn't sound any better. It was very slow going, but I do like though. I like the fact that there's an actual focus on fixing all the things that are broken within the product. Because I've used the mobile app, and I think it's garbage. And I spent about 15 minutes at a grocery store just trying to see if I could pay with it, only to have the manager give up and say, yeah, it's supposed to work, but I don't know. And just going through it, you try and pay somebody, there's like 5 different places to do it. And it's got like send, and then it's got like 7 different options for sending. It is trash. So, I mean, that part, I actually think that that's what they should be focusing on. They should be trying to make it to where people complete orders because it's easy to use, like the biometric verification. They should be making it to where I can actually open the mobile app and click on something and pay somebody sitting in front of me. That's something that you've been able to do in Asia for like a half a decade or a decade, and we can't do it here easily. So I do think they have to work on those things
with anything you're saying, but there's a much better way for them to say it.
It was articulated.
They came out and said everything that you love about PayPal, the reasons that you use PayPal are just going to get better. You're going to see over the next 3 months how much better it's going to be, and all the profits that we generate, we're going to continue to reward shareholders. Like they need to hire a freaking publicist. Like whoever's their publicist should be fired.
Yeah, my options account is going to agree with you for sure. It's definitely going to agree with you tomorrow morning.
I think if you're going to turn around a ship, you need to be aggressive, and I feel like they think they're being aggressive, and they're not. I think
this guy needs to go to the school of Alex Karp. I mean, when you think about when he banged his hand on the table, everybody got pissed off, including myself. Like I said, I'm giving this company a year, and then I'm out if it doesn't change. I don't know who the hell they hired, but Alex Karp, please give Alex Chris your publicist and whoever you worked with, because it has been night and day for the past year. Night and day. And it's so frustrating because PayPal has so much freaking potential. And this was an earnings call that I think every analyst on that call was laughing at. They're like, what type of answers were those to questions?
Yeah.
The optics sucked. It felt like
horrible.
Tesla, honestly.
Yeah.
It felt like Tesla's last
exactly.
quarterly. Yeah, because it was just like everything that they said, you're like, what did you just say? Why did you just say that? And that felt like a lot of this call. And again, it didn't help that like literally the merchant video that they did, it felt like it was just a regurgitated version of that, but not as eloquent and without slides.
So we're down.
And then they were very dark on the effort that it's going to take over the next. They did say, 2 weeks to a couple of months, they're going to be able to actually get these, products out there. And then it's about increasing adoption. And it does, like I've worked in a developmental world. It does sound like they've made a lot of progress in a short period of time, but I don't know if the stock market's going to care about that tomorrow.
I think the biggest problem is that the numbers that they actually put out are facts, and the things that are opinions are the things that they screwed up on. Guidance is their opinion. Okay. The earnings call and the things that they said were their opinions. And that is the part that is absolutely shitting, the stock right now. Aside from the actual numbers that they actually put out, which were fine.
And Tanner, look at it this way also, because the numbers they put out weren't fine. They were very good. They were borderline great. Like this is a strong fundamental company.
Outside of guidance.
But
it is a holiday quarter though, but I just want to
No, but this is going to be the narrative in the bear case. I shouldn't even say, because if they're not thinking it, I don't want to give them any ammo. But if I was a bear, which I may turn into now, I would say all these buybacks that you have done on the whole way down, you have just destroyed shareholder capital and value, and there's no way back.
Yeah.
Like, this is insane.
Unless they continue to till they're private, which I even wish they did something like that. Like, if you're going to be more aggressive, either cut way more, look what Elon did to X, like just obliterate and fix. Like, people I think would be even more happy with that versus even buybacks. Like, even if you just came in and said $6 billion in buybacks and let people assume acceleration in buybacks because of the lower price, that would have even been a really
hint at
strong
consolidation in the future. They have all these pain points. They have so much that they need to change. They could even hint that they might be doing further cost-cutting measures in the future, and the stock would take off.
Well, I think that they hinted at both of those. Their hints were just not nearly as obvious that they should have been. They should have highlighted them instead of just we'll casually mention them. So in the slide deck, page 12, guidance, share repurchase says at least $5 billion.
Yeah,
they did not have that.
$18 billion in cash and investments and $11 billion in debt.
So this at least number is saying we're thinking about raising that. We're thinking about accelerating that. We're at least going to do $5 billion. So it's
Should have just said
different.
6 at these rates.
At this point, they should just sell themselves to Apple or take themselves private and let them be a cash register for private equity.
And they mentioned the cost cutting and efficiency a number of times from Alex Chris, from Jamie Miller as well. So, but it
Yeah,
was
but Roy,
not.
that's not
It was
the
not clear.
problem. This isn't a company that needed to do cost cutting. Like Meta needed to do cost cutting because of how much money they were losing on Reality Labs and the perception of it.
This whole panel.
I mean, they definitely had that. I will argue though that they do need to do cost cutting because they should be on a single platform. The fact that they didn't even have reporting that was single platform,
Yeah, that's crazy.
The ability to aggregate any of this data is pathetic.
Okay. And I agree
So
with
it
that.
sounds
But
like
that's
they're working with
efficiency, and if it leads to cost cutting, fine. But when you talk about like true cost cutting, this is a company that was highly profitable, that wasn't losing tens of billions of dollars on a figment of Zuckerberg's imagination, which I gave him all the rope in the world for, because you know what? He earned that right.
You know what's funny is the stock I'm just watching bottomed out right whenever the call ended. It's been going up since.
It did.
So that call was
What
really.
are you talking about? Did 58.42?
No, it's at 58.90 now.
Oh, 58.90. Okay.
I'm just saying it's bottomed out. I'm just saying it's recovering now that people stopped listening to the call.
Like, I'm so angry. Maybe I calm down in an hour tomorrow, but I'm so angry that I may just buy back my covered calls and sell tomorrow.
Listen, Steve, do not write your article today. Wait a day. Okay, read the transcript.
I cannot wait for the transcript to come out because there's one thing I'm blanking on that I almost fucking swerved off the road. Like, there was one thing in there that pissed me off so bad.
Yeah, what was it?
Oh, my God.
Do you remember what it was?
No.
Probably fell
He
asleep.
just went into a fit of rage. He blacked out.
Yeah, Steve, you're a numbers guy. Cool off a day. Look at the numbers.
And that's the problem. The numbers are amazing.
They are. Yeah. So what they've done, they've really shot themselves in the foot as far as near term, price action. I think I don't know what's going to happen near term, but I think when people process and say, okay, EPS is actually not really flat. It just we thought it was because the initial thing that might help a little bit, but yeah, the narrative, like they're like, hey, we're going to lay out the bear case and like tell you like we're not giving you a base case, we're giving you this is all bearish stuff. So they left plenty of upside surprises, but I would have liked them to be a little bit more aggressive on that and just say, hey, this is what we actually really expect. So
I think they could have been they could have been more clear on the struggles and the things that they're focusing on and what they're trying to, and then they could have spun that around into more positive, like, hey, they could have done both. They could have done both. They could have set expectations, still had lower EPS, and done a better job with this. I'm almost wishing they did have dividends down.
I mean, the messaging was horrible. The messaging was completely horrible. I do hope they maybe learn from Adyen. Adyen's last year went down 50%. They said, okay, you know what? We're going to do a special event for the investors, something we don't do. We're going to show you what the real numbers are with better messaging. I really hope PayPal learns from them a little bit. But in this call, I got the feeling they were very, very scared by setting up some higher expectations. I mean, the bar is now so low, I can even bury myself in it. It's ridiculous.
It is low.
Or not Roy. I already know Roy does this, but Neil, do you follow and track Adyen as well?
I do. Yeah, I do.
Okay.
Not as closely as PayPal, but I do. Yeah.
They're covering second half earnings coming up. So I want to invite you now. I'm going to be doing that live, but you're more than welcome to join as well.
Those are my northern neighbors.
Perfect. So I completely agree. I think the problem is I think that Alex Chris thought that was the shock the world event. I think that I hope that he didn't think that was his investor.
Go to sleep event.
So he
like,
needs
look, this guy, this is his first conference call. He needs to come out and be confident.
Yeah. Aftershock the world. Yep.
He needs to go back on CNBC tomorrow and start pumping up the stock.
Almost afraid of that.
I saw a bunch of people commenting, well, I'm definitely shocked after the earnings call.
Yeah, I'm shocked at how good the numbers are and how you can absolutely destroy the message after those numbers. How do you not play that up?
I mean, honestly, I'm going to let the business speak for itself. I think my plan right now is to just hold. I don't think I'm going to buy
Yeah, but we've
anymore.
been doing that, and the business has been speaking, and nobody cares. Like, it doesn't make any sense.
I
It
think that
hasn't been speaking that much.
if you can give time to give Alex Karp a chance, who's been an
I wish it
operator
was
for that
Alex
business-
Karp.
No, but you let him change around his style of speaking on these earnings calls, and he's been an operator of that business for 18, 19 years. Alex Chris stepped in. Maybe he came in a little too strong, thinking he was a big dog, wanted to make a name for himself. He's realizing he's probably just.
But there's a big difference. The difference is Palantir was a true growth company that was getting slammed and needed to grow into a valuation and prove once and for all that they weren't a black box, that AI is real, their products are real, and they're monetizing and they're blowing everybody out of the water, which they did. PayPal is already a mature company that you can trust the numbers and you know the profitability. They needed to come out and give a much different message that, hey, we're PayPal. We're not going anywhere. Everybody should be afraid of what we're going to do. And you know what? The stock is way too cheap. So forget the $5 billion in buybacks. We're going to buy back more. We're going to take $4 billion off the balance sheet because we don't need to lock that up in treasuries. And we're going to buy back more shares tomorrow on the open market because this doesn't make sense. We believe in ourselves. They needed a much different message.
Agreed.
Well, that still can happen. It was definitely wrong, but yeah, I think that this is
Tanner.
If
They
I
are
were rating
trading
on
like
it,
a
it's
tobacco
hold
company
right now. It's
Think
a hold
about
for
that
me.
for a minute. They are
Yeah,
trading
they
like
are.
a tobacco company.
Yeah.
If you
They're
look
at
at
the price
first
they were at over
earnings
6.5 years ago.
This is bad.
Yeah. Yep.
Yeah.
And the
I mean,
question becomes, what do they need to do to turn this around now after this? Like,
Yep.
I think that's what I'm upset about. What the hell do they need to do to get people to flip the mind?
Take it private.
That's the only choice at this point.
Yeah,
That's
I
what
think
Shift
that's
Four
it.
came out and said, and
Expectations
there's
low enough where it won't take a lot from here. If they
Well-
just start beating on any of these metrics, it'll be more positive. And if you're right, if they can get better marketing, they need better optics.
If you guys followed Shift 4, ticker symbol 4, FOUR, this stock was hovering in the $40 ranges forever. And then they said, you guys don't like us? That's fine. We'll buy ourselves. We'll go private. This is ridiculous. And now the stock hovers 70 to 80 right after that call. And then they also got helped out by another payments company, by the way, very similar space. But they also got helped out by an article that came out that said FIS was in talks to buy them out. FIS later came out and said, we don't, that's fake news, but that didn't even matter. The stock still held. So things can go by. I'm a fundamental investor. I see the fundamentals are doing fine. Guidance isn't great. I'm going to hold. Neil, you were going to say something?
Yeah, I mean, throughout the call, it really reminded me at how slow and bad PayPal was managed throughout the last couple of years. I mean, for everything that needs to change right now, it's crazy how big PayPal is, and yet they haven't done anything to actually catch up to the year 2024.
In years and years.
Can we get the
insane.
Takeout Mafia back? Get Peter Thiel back? Get David Sachs back? Like,
No.
let's get these guys back.
Max Levchin, maybe, yeah.
Yeah, maybe.
Like I really don't understand though. Like inflecting the gross margins, like that was everybody's focus.
Yeah,
and they should have pounded the freaking table on that and just said we mentioned
Did they
it as a
talk about it?
company for this long. We said and even guided like, hey, this was not going to inflect Q4. Guess what? It inflected just like we promised. PayPal delivers.
Yep.
We're expecting these things. Some of these we need to kind of wait and see, but these things are going to happen just like this. We continue to see this improve. We see macro improving. This is a growing company. And you know what? If the market doesn't believe it, we're going to take this thing private.
I agree.
There. Boom.
I agree.
Done.
I think your
Mic
ace
drop.
is big brother now, Roy. I think you should have been doing the call.
he sounded like Dan Schulman, honestly, like for
A
until the
little
end.
bit, yeah.
And I'm like, dude, what happened? Are you like, did you not sleep well last night? Like, come on.
Compared to the first time.
You could have deep faked that whole call, Roy.
If they need me, I mean, give me a call, you know? I'm excited about the company. Like the numbers, the numbers are, none of us are bearish on the numbers. We're like, the numbers are good. They're very good. Expectations, EPS that they put out, the guidance, that was not good. In the only areas other than that I saw, you know, we knew like the active
Hannah, bring
users.
up that thing from 619 from Machiavelli. The new PayPal mafia is being run by Fredo. I couldn't have said it better. That's great.
Jesse, what were your thoughts on the call and how are you playing this?
I'm gonna hold. First off, I'm not gonna sell into the options tomorrow. They're probably gonna go down like 40%. So I'm not touching any of that. I'm gonna hold. I think that despite bad optics, I liked a lot of what he said. I like the single platform. I like the fact that they've already come up with new products, figured out what the pain points are, figured out what they need to do to fix them. They talked about, you know, focusing on a single view, being able to cross sell, having to get all the reporting to where it's not in silos. And they've done all of that in a really short period of time. I used to work for a software company. If they did everything that he just said in a period of 3 or 4 months from when he started, I think that that's actually really impressive. But I thought the optics of the call sucked. I do like the fact that he said that this will allow them to have accelerated engineering velocity. I said this before the conference call, that the mobile app sucks, and that I liked what happened in this, merchant call where they talked about using biometrics to make things quick and easy, using Fastlane to make the process a lot easier for guest checkout to where they don't have to punch in a bunch of information. I love the fact that they're grabbing all this extra data so that they can figure, I mean, you think about it, these guys from a data standpoint, from a merchant data standpoint, they've got like the most data on the planet. What is it? 25% of e-commerce going through them. So it's awesome that they actually start to use that and they recognize what a powerhouse the data is. Now, what I don't know from an options perspective is how quickly they're going to be able to execute on all this and whether or not January 2025 is going to be a lot of fun. So I don't know. That part sucks. But I didn't hate what he was telling us. I hated the messaging. I got to agree with Neil and Roy and everybody here. The messaging sucked. It could have been done way better. It could have been done with more passion and conviction. I don't know. Maybe they're just so deep in the weeds and they've been through all this pain and suffering in the last like four months that they couldn't muster up the courage to be a little more excited. I don't know. But the call sucked. That part sucked.
It's almost like they're afraid because they're on probation for 3 months at a new company. It's like, you're the CEO and CFO. You're not on probation.
Yep. Grab it by the horns.
Schulman's even off the board. Like, you're in charge. Go.
Yeah,
That's what I'm wondering too, Jesse. Like my shares, very confident, fine. My leaps, yeah, like I may need to roll out a year. It sucks.
I mean, if you have leaps, you got 2 years.
But they go from this today, they could drop really quick overnight, like really quick. They could bleed 40% probably by tomorrow morning because there's going to be a bunch of people rushing for the door. I mean, I look at chat. That gives me a pretty good indication of what's happening to the leaves. I will definitely be following the 3-day rule before I even think about rolling anything out because there'll be a lot of people flushing out and then there'll probably be institutional coming in.
Yeah, so, I mean, this guy's got to go on CNBC tomorrow and Bloomberg tomorrow and say something completely different. I mean, if
just
he doesn't
say shock the world.
No, please don't. I'm going to have to tweet him tonight. Hopefully he sees it. Give him some pointers. I'm going to have to let Tanner read it first before I fucking hit send.
Love you, buddy. I think that is one type of CEO that we might actually be able to get on the channel. He does have a lot. He does talk to retail. Yeah. And we can have him on the channel and he can talk about Fastlane. So that'll be good.
No, he should not be allowed to talk anymore. Enough.
Get him started, Tanner.
Like,
and the funny thing is, those products could be huge products.
Not until he gets it. You know what? This guy needs a shot of B12. I want his blood work done. Let's see, like, if this guy needs something. I don't know. Like, maybe he isn't sleeping well. Like, let's figure this out, because he was so monotone and he just didn't even seem like he wanted to be there.
Yeah, it's not
Yeah.
a normal Alex Chris. Like I've listened to stuff going back to 2017, and I don't know.
Well, ladies and gentlemen, I think that's a good place to wrap it. Down in my description down below, I have all the links for everyone on X. The only person I don't have was Steve, because he was a late entrant. But you can check him out at Dividend Streams. It's right there on his name in the beautiful purple there. And everyone, I think, has their X on the screen anyway, or you can go down below. Appreciate you guys. Hope you guys do well. But bye for now.
Fun. See you guys.
Bye.